this is, I think, the biggest pensions conference in the country, if not the only, and brings together all the various stakeholders. Yes, you can put your hands together for yourselves. So we've invited different people in the pensions ecosystem, the financial system, and also the media to cover this. We're also streaming, so which means that a number of people have joined us virtually, not just from Ghana, but from elsewhere, to take part in this very exciting conference. So we look forward to having a very exciting day. Now, there are three main things we do here. We definitely hear speeches, which are important to set the scene. And then we do what I call insightful presentations. So you have technical people who bring some very clear light on important aspects of our economy, useful for our work and our future. And then, of course, we do panel discussions where we cross-fertilize ideas to bring the best to the top. So it's going to be a lot of fun this morning. So I'd like to start off by inviting Emmanuel Intre, who's the head of fund administration at Axis, to come and lead us in a quick opening prayer. So let's put our hands together for Emmanuel Intre.
Thank you very much, Bernard. Shall we please be on our feet whilst we take the opening prayer? In all humility. Shall we pray? Father, we thank you, we bless you for the gift of life. We thank you for making this conference possible. We commit all the speakers into your hands, O God. We pray that you grant them the tongue of the learned, that Father, they will provide wisdom and divine strategies, O God, that will equip trustees and all the other stakeholders to be able to make informed decisions so as to profit members of their various schemes. We also commit all those who are on their way coming, that you grant unto them traveling mercies. We thank you, we bless you for a successful conference to the glory of your name. In Jesus' name, amen.
Please be seated. Thank you very much, Emmanuel. A conference like this is enriched by the quality of the speakers and the resource persons. And I'm very happy to announce that we've arrayed a stellar group of lead thought people, or I call them thought leaders within the sector. Even though I'll introduce them in more detail before I call them, I think it's just fit to mention some of the names of people we're expecting. I think for the first time we have a keynote speaker we have imported. So now we are international. You know, in the past we had great keynote speakers who just sit in a car and come. Now he sat on a plane. Or was it a helicopter? Botswana is far. Certainly not a ship. So we're happy to introduce for the first time our keynote speaker, Paul Masie. Please rise for a round of applause for you, sir. Thank you, sir. He is the chairman of Alexander Forbes Botswana. We're looking forward to hearing from him. I think I know why we invited him, because last year when we're discussing some of the sectors and countries that were exemplary, I think Botswana came up strongly in how they had unlocked their pensions and they were doing great things. And they had invested in companies that were doing very powerful things on the continent. So we're looking forward to hearing from you, sir, and we know you will not disappoint. Put your hands together one more time for our keynote speaker. So I can say our conference convener is the CEO of Axis Pension Trust. Ladies and gentlemen, acknowledge a free Oware. Wonderful. Thank you. We are still expecting the regulator for the sector, Christopher Buedi Mensah, who is the CEO of the MPRA. I will acknowledge him when he shows up, but you can put your hands together. Now, the quality of the panel we've invited suggests to you our intentions for deepening pensions. So I'm going to call some of the panel members just to give you a flavor of who we're going to hear. In no particular order, we have the Deputy Director of Finance for Ghana Cocoa Board, Yvonne Esson. Yes. Thank you, Madam. We have from the Ghana Ports and Harbour Authority, General Manager Finance, Tebon Zuma. You think it's the consumer's brother? The way you are looking, Zuma is also a Ghanaian name. From Stanbic Bank, we have Robert Yeboah Amponsa. Robert is the financial controller. From Temple Advisory, we have Robert Marshall Benning, founder and chief learning strategist. Good things happen in twos. This week I interviewed this gentleman, and now he's sitting in front of me, Chief Investment Officer for Blackstar Advisors at J. Boateng CFA. All the questions you escaped on TV, I'm coming to target you here with those. Pa Kofi Ankoma is the General Manager for Access Pension as well. He's one of the people we hear from. West Bakwesi. Thank you. Of course, Nana Wiafi Buama, Chief Investment Officer, Access Pension Trust. Now, one of the highlights of the conference are those insightful economic analysis that the Access team puts together for us. I'm looking forward to hearing the two of them deliver that. We also have Gideon Amweniche, who's the investment strategist for Access, also join us. Gideon, thank you so much indeed. Then I'll mention a few more names quickly. William Mensah is the Executive Director of Bora Capital Advisory. William. One of the first people we interviewed when we started CTFM in 2005 was William Mensah. When we look for guests, we don't get William. I think you were at EDC or something. Where were you? You were somewhere. Now you were CEO. Those days you were not. It's good to see William. So what are we going to do? We're going to hear the opening speech from the CEO. Then we will do the presentation on the economic outlook and strategies for building resilient pension portfolios. This is important because it's a new government. There's like a reset going on, and therefore this is going to be very important for some of the things we'll be doing for the next few years. So please watch out for that. We will do a few minutes of Q&A after each of the major sessions to make it more interactive. So when the team does the presentation, we'll bring the mic around and discuss and ask questions. When we also hear from our keynote speaker, we'll open the floor again and make it a bit discussive before we come into the main panel discussion somewhere in the afternoon. Is that a good plan? Then smile. You look too serious. Wonderful. So I'm going to now call Efriye, who is the CEO of Access, to bring us opening thoughts. Please put your hands together for the Chief Executive Officer of the Access Pension Trust, Efriye Oware.
Thank you very much, Bernard. I am told the MPRA is not likely to come, so I will add their time to get things off my chest. Good morning, distinguished guests, trustees, fund managers, esteemed stakeholders, ladies and gentlemen. It is a profound honor to welcome you to the 2025 Pension Strategy Conference. I believe most of you would agree with me that the past 7 years has been a very turbulent period for Ghana. From 2017 to 2019, we witnessed the financial sector cleanup, and then in 2020, 2021 was COVID and the disruption it came with. And just when we were settling down, we also were rudely welcomed by the sovereign debt crisis. So it's been a very turbulent period for us. Fortunately, in the past few weeks, we've started to observe some seeming recovery, and we want to believe that we have an ideal opportunity to rethink and imagine how we rebuild a more resilient pensions industry going forward. So to anchor today's conversation, I will trace the evolution of pension funds over the past 14 years, from 2012 to 2017, 2017 to 2021, and then 2021 to date. And I will also seek to propose critical pillars for consideration for us to be able to achieve a more vibrant investment landscape. And so I will start with a journey through time, pension investing in Ghana. Phase 1, 2012 to 2017. And I term this period a conservative beginning. Overall, across all three investment guidelines the MPRA has issued in its life, I will say that the asset allocation targets for the various asset classes have been vastly the same. There's just been a very small variation, but largely I would say it's been the same. The maiden investment guideline was understandably very conservative, allowing up to 75% of pension fund assets to be invested in Government of Ghana securities, 30% in local government and statutory agency securities, 30% in corporate debt, 10% in listed equity, and 35% in money market securities. In line with the initial intent on stability, trustees heavily leaned on government instruments and high-yielding fixed deposits, investing 63% in Government of Ghana securities, well below the 75% allocation. Investments in corporate debt reached just 8% out of the 30% allowance. Listed equity was a mere 3% out of the 10% allowance, and money market stood at 23%. So in the first phase, 2012 to 2017, we had money market and Government of Ghana securities being the prevalent asset classes. Given the early stage of the market and the prevalence of high yield chasing investment behavior at the time, I would say a cautious investment approach was appropriate. And we must not forget that it took the decisive intervention of the MPRA under the leadership of the late Sam P. may his soul rest in peace, to stem what could have been a disaster for the pensions industry in the infamous financial sector cleanup. Nonetheless, some pension funds still got bitten. A few got their funds locked up, and a number that invested in fixed deposits also experienced a haircut. And so for your information, the first time we experienced a haircut was during the financial sector cleanup. I must say it was a very painful moment for the pensions industry and a warning to us of what could go wrong. So phase 2, 2017 to 2021, I call this period risk aversion and overexposure. The unintended consequences of the financial sector cleanup was a deep-rooted aversion to risk among Ghanaian investors, including pension funds. As a result, pension funds trustees flooded into Government of Ghana securities, ignoring the mounting risk of ignoring the mounting sovereign risk. While the financial sector was being cleaned up, government finances were deteriorating, and it was very evident between 2019 and 2021. Despite the updated guideline that was issued in 2017, aimed at promoting investments, diversification to the private sector, to spur real sector growth, portfolio composition moved in the opposite direction. The panic set up by the financial sector cleanup, compounded by interest rate haircuts and the delayed payouts to depositors, drove the industry into a flight to safety mode, culminating in an overwhelming 84% exposure to Government of Ghana securities and the local government and statutory agency instruments. Yet again, as trustees, we ignored what could go wrong. And then came phase 3, 2021 to the present. I call it a system under siege. and I believe you would understand why. The latest investment guideline, launched in 2021, introduced constituent funds and life cycle investment models while removing the mandatory 30% allocation to government bonds. I want to believe it was a bold attempt to shift focus towards the long term. Yet, the limited supply of credible investment alternatives remained unresolved. The economy imploded, inflation rose, asset yields escalated, and pension funds lost money in real terms. And I must say, the bond market collapsed and has still not recovered since then. Despite all of this, as of 2023, 83% of pension fund assets remain invested in Government of Ghana securities. Trustees have still not pivoted away from Government of Ghana. The lesson was not absorbed. Even the former president, President Anado, in 2023, in his address to Labour on May Day, urged pension funds to diversify into the real sector. I believe the warning could not have been clearer. It is not the role of government to create assets for us in the pensions industry, and it's never been anywhere in the world. So what is the root cause of our collective failure as an industry to diversify towards the intended asset allocation? After more than a decade of failing to lift our private sector share of pension fund investing, I believe a rethinking has become urgent. The current investment guideline has an implicit assumption that Ghana's financial market offers enough viable options for true diversification. But in practice, trustees have overwhelmingly retreated to what they perceive as safe and available: government debt. Ironically, the very source of our financial fragility. Is this a rational behavior or a rational response to the lack of choice? The likely answer may be both. To rebuild a truly resilient pension framework, we must undertake deep structural reforms for successful implementation of the current investment guideline. And I propose 6 key pillars for consideration. The first one, capital market development. Equity allocation stands at a dismal 3%. Think about it. Our capital is the longest, or is the only long-term capital that is available in the economy of Ghana. Yet only 3% of it is invested in equity. This reflects not just trustee preferences, but a lack of viable, investable, and liquid stocks to absorb the burgeoning pension fund assets. Trustees, other capital market operators, and government must invest in listing stronger companies, improving governance practices of Ghanaian businesses, and deepening market liquidity on the stock market. The free float we have is pretty small, and I do not think that the stock market has got a bandwidth to even accommodate 15% of the total pensions industry AUM. Without a vibrant stock market, long-term capital will remain elusive to Ghana's private sector. The second pillar for reform is corporate debt market reform. Ghana's underdeveloped corporate bond market, accounting for just 1.5% of total bond market activity, signals a deep weakness in the private sector, compounded by high non-performing loans ratio of 24% as of last year. And I want to believe this reflects poor creditworthiness and weak debt culture of Ghanaian businesses. Most Ghanaian businesses remain too small and fragmented to absorb significant capital, limiting their access to financial markets. Also, the decline of once prominent SOEs, like the PBC, left a sour taste in the mouth of pension funds and other investors. To build investor confidence and for capital market growth, Ghana must promote mergers and acquisitions of its businesses to build scale, strengthen corporate governance, and foster a culture of transparency through credit issuer and instrument rating. Big businesses anywhere in the world are better shock absorbers than small businesses. And so if our capital market is not developing, it's because our businesses are too small. And we need to, as a matter of economic development strategy, pursue consolidation of Ghanaian businesses. The third pillar for reform, money market modernization. Ghanaian investors have traditionally favored high-yield, short-term fixed income instruments. We have very little capacity for risk-taking. However, the absence of a structured money market securities has confined these investments to over-the-counter transactions predominantly issued by banks. And I remember before the financial sector cleanup, there was this perception that investments in fixed deposits were safe. But during the financial sector cleanup, we came to the realization that this is really not the case. Meaning that a lot of us are packing our money into fixed deposits without really understanding the riskiness of the instruments we are investing in. The lack of formalization limits transparency, liquidity, and broader investor participation in the money market. And I wish to propose that the Bank of Ghana and the Ghana Stock Exchange should collaborate to foster the creation of an organized issuance market for fixed deposits. Additionally, the introduction of a formal commercial paper market by the Ghana Stock Exchange in 2024 can be leveraged to diversify investment options and provide more efficient funding options for issuers. These initiatives are pivotal in fostering investor confidence and attracting greater pension investment in the private sector. The fourth pillar, revitalizing local government. We allocated a whopping 30% of pension fund investment guidelines into this asset class. To date, there's very little that is allocated in it in terms of real investment. Why is that the case? The dream of municipal bonds remains unfulfilled, hindered by the fragmentation of our cities into small municipalities, thereby limiting their financial autonomy and credit worthiness necessary for successful bond issuance. I don't know how many of us here would willingly invest in the bonds of AMA. Because if you ask me where the boundaries of AMA ends in Accra, I can't tell. I'm told it doesn't go beyond the National Theatre. And so our district assemblies lack scale and the requisite size to be able to issue municipal bonds. Ghana must undertake political reforms to consolidate municipalities, enhance their governance, and establish a robust regulatory framework for local government development initiatives. These steps are essential to transforming local governments into effective agents of economic development and to attract investments through a viable municipal bond market. For those of us who do not know, the Chinese economic miracle was born out of their municipal and district assemblies, creating development plans, backing them with the requisite capital to ensure that their municipalities develop. For Ghana to develop, we need to go a similar way. The fifth pillar, unlocking the real estate investment opportunity. Real estate is currently embedded in the alternatives asset class, and I consider it as a significant opportunity for us. Real estate holds immense promise, but is constrained by chaotic land tenure system, poor urban planning, and this morning I heard Bernard talking about it on his show, and a fragmented land administration system. We must revisit the examples of TDC, Dansoman, and Sakumono estates. Government should legislate for land use reform where the granting of land leases across the country vests in an agency of the state. I think we are tired of the land tenure system. And if we just replicated the model of TDC, I want to believe that we can sanitize our real estate sector and make it more investment friendly. I also believe that our government should empower structured real estate development in our cities. In more advanced countries, individuals are never real estate developers. Land banks are zoned and allocated to real estate developers who do the building and the construction. Individuals can never absorb the cost of putting in infrastructure in the suburbs. These things can only be done by institutions or the government, and that's the way we need to go. And I dare say that our government will need to consider building modern cities, not just settlements. If you drive through Accra, the further away you move from the colonial districts, the more chaotic it gets. This, for me, is a signal that as a country, we are failing. And these are some of the things I wanted to get off my chest. I believe these reforms are not merely about real estate. They are about national development transformation. A modern Ghana requires modern cities. And that begins with bold, coordinated action in land use governance as a precondition for a vibrant real estate investment market. Now, the risk we face is that because the real estate market is not deep, if pension funds start packing money into real estate, there is just not going to be liquidity should the need arise. So you get locked up in an asset you can never dispose of, even when it doesn't meet your investment criteria any longer. And so we need to ensure that the real estate sector is sanitized. My sixth point for transformation, we need to imagine or reimagine state capitalism and its role in our economic development in Ghana. Our pension funds have continued to place massive bets on the public sector that traditionally had underperformed. Meanwhile, the private sector struggles with limited access to credit, receiving only 13% of GDP, significantly below the African average of 20%. This is in stark contrast with public debt levels, which currently stands at over 75% of GDP. As the most favored borrower in Ghana, the government can use its borrowing power to initiate commercially viable projects in partnership with private sector as operators, not government as operators, and pension funds as financiers. Public-private partnerships, like the successful Trefo oil palm plantation, BOP, which were developed between the government of Ghana and the European Union, I believe exemplify how collaborative efforts can drive economic development. We either build quality assets locally to absorb the flow of funds from the pensions industry, or we brace ourselves to export our capital. If we are saying that we cannot find viable private sector businesses to invest our money in, and government is also not able to deliver on commercially viable projects, then clearly we are saying that we are not good users of capital. And so our capital should be exported where it can be efficiently or more efficiently deployed. A call to leadership. Colleagues, fund managers, and trustees. Our collective inaction will jeopardize the future of millions unless we change course. What we have seen in recent times can replay again. It is said that it is only a fool that keeps doing the same thing, expecting different results. And until we change course, we will go back to the same situation. And I think it will be more painful then. We can no longer continue to kick the can down the road. We must decide whether we invest in the host, in which case these are private businesses, or we continue to invest in the parasite, in which case is the government. Just think about it. 75% of GDP sits with government, and their cost must be borne by businesses that are only receiving 13% of GDP. My question is, do we continue to invest in the milk harvester, or we will choose to invest in the cattle? Political leadership in sustaining economic or macroeconomic stability is key. I believe President Mahama has pledged fiscal discipline, and we can see some evidence of it. The Bank of Ghana, through the Gold Purchase Program and the more recent introduction of the Gold Board, are showing commitment to monetary restraint and are accumulating foreign reserves in a manner we haven't seen in Ghana before. But these alone are not enough. We must complement those efforts by leading with vision, with courage, and with continuous advocacy for better economic governance. If we look on for politicians to destroy the economy, it is our savings that is going down the drain. Think about it. The CD was 6.4. If you had 100,000 Ghana cedis in assets, you had $64,000. As at the end of 2022, what will be the value when the exchange rate was 16? And this is a reality we need to guard against. And I want to believe that our shaping role starts from conferences and discourses such as the one we are going to have today. This year, as Bernard announced, for the first time, we are spotlighting an African peer, Botswana, for very good reasons. How does a country of just 2 million people, less than 250,000 contributors, marshal pension fund assets more than twice ours in Ghana? We are honored to have our good friend, Mr. Masie from Botswana, as our keynote speaker. His insights will throw light on what is possible when policy, market discipline, good stewardship culture, and long-term planning come together. We have also assembled 2 expert panels to examine the theme, Rethinking Pension Investments, Policy, Innovation, and Market Opportunity. These discussions are important and urgent. They are about your future, my future, and the retirement dignity of millions of Ghanaians. Let me end with this. The decisions we make will either perpetuate a cycle of economic vulnerability or forge a path towards financial security, prosperity, and economic transformation. Let us rise to this challenge together. Thank you for your dedication, for your stewardship, and your presence here today. I wish you an insightful conference. Thank you very much.
Wow. Is it that you hear powerful speeches like this every day? So when you hear something like this, you just, hey. Wow. And you know what's interesting? A speech doesn't have to be loud to be effective. This was very powerful. You know, there are some boxers who come and swing like this and they miss. But some boxers just give jabs, you know, and I don't know. I think we need a commercial break to think about what he said. So many deep things. Efriye, thank you for showing leadership consistently over the past few years and for standing in front of us to say these things. So let's put our hands together for Efriye one more time. Wow. Somebody says, if you want to really grow an industry, you must lead. And I think that's what you're doing. So we appreciate the 6 pillars. And we will use them in other places. Very, very important. You left out with some very, very deep things. Our collective inaction will jeopardize the future of millions if we do not change course. Very important statement. Do we keep feeding the parasite, or do we keep feeding the fertilizer? So the milk, is the milk harvester versus the cattle? Charlie, it's good the MPRA guy is not here because your license may be in trouble. Wow, very serious things you've said, you know. And I like the 6, just for a reminder: capital market development, corporate debt market reform, money market modernization, revitalizing local governance, unlocking real estate investment opportunity, and reimagining state capitalism. We could break into 6 thematic groups right now and discuss. But this is just the foundation. We're going to move to the next level. Now, what makes the Axis Pensions Strategy Conference, in my view, is the word strategy. Because a lot of times, conferences come, we say things and go. But we are here to formulate a collective strategy so as a body of interested stakeholders, we will know what to emphasize for the next year. And one of the highlights of the strategy session is the economic outlook presentation, which also then suggests some key strategies for building resilient pension portfolios. So I need to explain this. So you see, collectively, as people in the pension sector, we need a strategy as to how to get the government to do the right thing and to also unlock the things Efie speaks about. But that will not succeed if your own investment decision is poorly done. So what the Gideon and Nana Riafi will typically do, it will set the scene with the macro environment, look at some trends, and then point us to potential places we can place our investments so that we will succeed together. And I think Axis has done well because a lot of times people don't want to share their insights with competitors. We've invited all of you here because we know that we can only succeed together. And so with those few words, I'd like to invite to speak to us the Chief Investment Officer for Axis Pensions, Nana Riafi Boama, CFA, and his colleague, investment strategist, Gideon Amoinin-Che, to take us through the economic outlook and strategies for building resilient pension portfolios. Gentlemen, thank you and good luck. You're going to start? Okay, prefer this? Wonderful.
Thank you very much, Bernard, and good morning once again, distinguished guests. It's my pleasure to present to you the highlights from the Economic Survey and Outlook Report for 2025. And 2025 indeed has been a year that has been marked by some challenges and promising shifts in our economy. So in the next few minutes, I'm going to walk you through some key macroeconomic indicators, and we'll look at Ghana's GDP growth, inflation and monetary policy, exchange rates, and then we'll look at how these indicators and the economic landscape has shaped our financial markets. That's the Ghana fixed income market and the equities market. And then my colleague, Nana Riafi Boama, would continue and walk you through our views on the various asset classes and some study on asset allocation that we have conducted across some schemes. I would move on and start with Ghana's GDP growth. And as the headline here states, our GDP growth signals cautious optimism for long-term investment performance. And if you look at the graph indicated here, focusing on the black trend line we have here, you can see that Ghana achieved a very strong GDP growth in 2024, 5.7%. The most important thing here is, if you look at the trend line, Ghana's ability to rebound back, from slowdown in growth is quite prominent. If you go back to 2020, we were impacted by COVID and growth slowed down to 0.5%. In 2023, we acknowledge that DDEP had an impact on the economy. Growth also slowed down, as you can see there, 3.1. But through it all, we've been able to have a strong rebound. And this suggests that we are still on a recovery path and we have expanding economic opportunities to invest. I would move on to the sources of growth in terms of the various sectors that have contributed to this GDP growth. And in the graph, the sectorial graph you see below here, you can see that growth hasn't been even across board. We have the agri sector, the industry, and the services sector. If you look at 2024, growth was largely supported by the industry and agri sector. But if you look backwards, you would see that consistently we've had the agri sector and the services sector sustaining our growth. It's also prominent to note that if you look at 2024, 2023, and especially 2021, you see that agri sector has been slowing down. The agri sector is the deep shade of green that you see on the screen. And this raises important concern that the critical sectors that have been sustaining our growth, it's important that we build resilient policies that would sustain and keep these sectors safe to also keep our GDP growth, going on. If you look at the cause for the agri sector slowing down, it's largely the logging and forestry sector that contracted. But one important thing there, that's the cocoa production, which falls under crops, also witnessed a significant decline of about 21%. And we all know how important cocoa is to our economy. So it's also important to also highlight this, that we need to support the cocoa sector. Now, these sectors I've mentioned constitute what we call the formal sector. There is another side of the story, and I'll move back to the graph up there. You see some yellow bars running through. That's our informal sector. Now, the informal sector currently constitutes about 28% of our overall GDP growth, and you can see that gradually it's also expanding. And this sector, despite its production and the fact that it accounts for about 80% of our workforce, is largely left out of things like pensions. And I would focus here on private pensions, where the gap that's widening is very prevalent. You can see a very small, deep-shaded green bars also running through there. That's the size of our private pensions in Ghana. That constitutes just about 5% of our GDP. It did increase to about 6%, but currently it's declined. And that's the latest data we have as of 2023. And this raises some concern that even though we are growing, our informal sector, we are leaving them behind. We are not including them in social protection and things like pension. And that creates a very serious risk for poverty in old age. Survey from our survey insights about GDP growth that we should expect, about 50% of the participants expect GDP growth to be moderate and should fall between the range of 4.1% to 5%. About 35% expect that GDP growth would also be stable and fall between 3.1% to 4%. And this range is just, we are using the 5-year historical average as the benchmark. Just about 5% expect GDP growth to contract for this year, and then we have about 10% expecting GDP growth to be very strong, between 5.1% to 6%. Whilst GDP growth is picking up, another important indicator that we need to focus on is inflation, which also affects our purchasing power. It filters through real returns and then interest rates. And here, the headline is clear. We can all acknowledge that Ghana is on a disinflationary path, but inflation pressures still persist. And this has prompted the central bank to initiate a neutral to expansionary fiscal policy response to contain the inflationary pressures. So all this is, the central bank has been adjusting the monetary policy rate slightly upwards or downwards to make sure inflation is contained. Now, if you look at the graph here, you can see a deep dark line running through. That's headline inflation, which really come from a high inflationary period. Currently, the inflation rate is about 22.1%. And if you focus on the deep shade of green, that represents food inflation. The gray bars also represents non-food inflation. And we can see that non-food inflation has been declining at a faster pace. If you look here, you'll see that our currency has been stable, and that's filtering through non-food inflation. For food inflation, we've had the impact of bad weather or adverse weather condition impact production, and so prices are still sticky or have remained high. Now, looking at this background, these factors, these currency depreciation, elevated food prices, are what is keeping us from the central bank's target. The medium-term target is 8% plus or minus 2. For this year, the target is 11.9%, and you can see where we are, quite still above the target. This is what has prompted the central bank to go into initiate a neutral or expansionary policy stance. This also reflects kind of a balancing act, because on one hand, inflation remains against targets. On the other hand, they have to be vigilant, but on the other hand, too, they also have to support the growth momentum. We all see how businesses complain when the monetary policy rate is increased. So it's a balancing act here. They are trying to pay attention to growth whilst also keep inflation under check. From the survey, about 60% of participants expect monetary policy stance of the central bank to remain hawkish. 40% expect a dovish stance. When it comes to inflation targets, a lot, I mean 70% expects that we will not achieve the central bank's target this year. It's just about 30% that believe we are going to achieve this target. With this, we know inflation also feeds into exchange rate expectations, so I'll touch on currency. And currency has been making the headlines, especially this week. The cedi is known to be the best performing currency globally. If you focus on the graph here, it reflects the headline you see there that we have had a period where depreciation has persisted, but we've also seen recently a rebound in the cedi's performance. If you look at last year, for a significant part, like I think the first 9 months, we saw the cedi depreciating. It depreciated to about 23% against the dollar, and then we saw the final quarter of the year, the cedi rebounding and appreciating against the USD. It's been a similar story this year. We went into a depreciation mode of about 5%, and just at the end of the first quarter, we saw a very aggressive rebound. I think year to date, the cedi has appreciated about 14% against the USD. Now, the factors that have supported the cedi's rebound have been the improved FX liquidity. We all know about the Gold for Reserve program. It's a program that the central bank has adopted to boost our gold reserves. Currently, I think over the past 2 years, the central bank has been able to accumulate gold worth about 31 tons from about 8 or 8.7 tons 2 years ago. And that is also helping influence the supply of USD on the market. We've also seen that unexpectedly, the central bank raised the monetary policy rate to make cedi investments attractive. It was raised by 100 basis points. That's also contributing to the stability. There are other things like the weakening of the USD globally because of what's happening with the tariffs. From the survey, about 95% expect that the cedi would depreciate. 5%, just about 5% expected an appreciation, which is currently happening. Now, from here, we'll look at how these have shaped our financial markets. And we'll touch on the fixed income market first. The fixed income market, what you see here is a reflection of investor behavior on the fixed income market. The first graph you see here shows the monthly treasury bill auctions and how successful they have been. You can see that the deep shade, which represents the 91-day bill, shows that a lot of investors have been geared towards the 91-day bill. If you look at the trend line in there, that's also represent the target coverage. It's basically how much government sought to raise against how much they accepted as bids. And you can see that it's generally been below 1%, which means they have been accepting lower bids than they targeted. Now, this also reflects that at least the new government we see is exercising some discretion in accepting bids, and through that, they are able to control the pricing of treasury bills on the market. Currently, it ranges between 15 to 17%. On the left side, you see here a reflection of also investor behavior on the secondary bond market. And you can see that on the secondary bond market also, activity has largely been geared towards the shorter tenors. If you look at the 4-year and the 5-year, even though there has been much more turnover, which means there's liquidity at the short-term end, it's higher than what we recorded last year. So overall, we have recorded trading volume of about 50 billion from the 3-year to the 15-year. On the last edge of the graph also shows the corporate bond trading activity, which shows that activity there has picked up, it has increased as compared to last year, and that signals that interest in corporate bonds on our markets is also deepening. Now, with this behavior, let's look at how it reflected in the yield curve. If you look at the yield curve here, the deeper shade of green shows the much more recent yield curve for March 2025, where you can see that there has been a significant shift in the short-term tenors down to about 15%, up from last year, December, where rates were around 27%. At the longer term end, you can see that rates, even though has shifted downwards, largely it hasn't been much. And that shows what I indicated earlier, the much more preference for shorter term tenors and the central bank being able to control pricing. That also shows the yield curve is steepening, which also presents both a risk and an opportunity for investors. Basically, it means that if you stay at the shorter term end, you are going to suffer reinvestment risk. Investors have to actually look at the medium to longer term end, but that would also depend on how they access government's ability and the economic conditions going forward. Survey Insight shows that the direction of interest rates at the short-term tenor is expected to decrease. 45% expected a decrease, 25% expected a neutral rate movement, whilst 30% expected an increase. And at the longer term end, 35% expected an increase, 45% expected a neutral rate, and then 20% expected an increase. I'll touch on the stock market. And on the stock market, the chart you see here shows returns that have been posted by the Ghana Stock Exchange Composite Index and the Financial Stock Index. The 2025 rate you see there is at the end of March. Now, if you look backwards, you see that 2025 was really a good year. We did score a return of about 56% for the whole year. The Financial Stock Index recorded 25%, and this was largely supported by strong corporate earnings, favorable economic prospects as analyzed by investors, and then also the depression of yields on the fixed income side pushed investors to look for higher yields on the equities market, which also came to pass. If you look at the compounded annual growth rate over a 3-year period, that has been about 20.57. A 5-year period is about 16 because of some declines that we recorded. There is also another side of it. Despite the fact that earnings have been strong, if you look at the charts below, you would see that, so this chart basically represents a return on equity on the financial sector stocks against their price to book value that we recorded as at the end of March. And you would see that even though returns are high, you can see that a lot of the stocks are concentrated at price to book less than one times. And that shows that even though earnings are high and earnings have recovered in the banking sector, investors haven't really priced that in. That's actually an opportunity based on how you assess it. I know that one factor that has contributed to this is lack of dividend payments by the bank, but currently banks, that has been lifted and banks are able to pay dividends. So going forward, maybe investors might have to look at the financial sector stocks because of the low valuations we see here. Survey Insights, 65% expect stock market returns for this year, 2025, to be strong, to be bullish, whilst 35% are expecting a bearish performance by the stock exchange. I would pause here for my colleague to continue the presentation and wait for your questions at the end. Thank you very much.
All right. Thank you very much, Gideon, for the excellent opener.
So I will continue the presentation with a multi-asset view. And this recommendation reflects the investment team's judgment informed by the insight gathered from the investment survey Gideon just shared. So on equity, as you see on the chart, green, we are bullish, right? And I've been bullish about equity, since. For tier 2 schemes, we feel an allocation between 10% to 20%, depending on the age profile of members, is reasonable. And our optimism is driven by the anticipated improvement in Ghana's economic condition, continuing disinflation, and a stable currency, which should boost corporate earnings. In equities, we favor dividend-paying securities and hope that under the reset agenda, the Bank of Ghana would interfere less in banks' board decision regarding dividend payout. Right? There are banks in Canada that have unbroken record of paying dividend, since the 18th, through COVID pandemic. I feel if the bank's capital is solid, nobody, should interfere in their dividend, paying ability. Right? On government of Ghana security, we maintain a neutral stance. Portfolios not marked to market, a common, albeit unfortunate practice in the pension industry, mask the inherent volatility of local currency bond. However, those bonds provide essential cash flow to meet liability obligation. And given the size of government and the size of that asset class, even advocates for private sector allocation cannot avoid significant exposure. We consider an allocation between 50% and 60% as reasonable. Anything above 70% could harm long-term performance, and I'll show that shortly. On corporate bonds, we are quite optimistic and would want to allocate more into that asset class, specifically for yield pickups above rapidly declining treasury rate. We prefer strong credit issuers managed by owners and management team with integrity. We prefer the non-financial issuers over the financial issuers, right? And I emphasize owners and management team with integrity because, the records are out there. If you look at the NPL, right, ratios in our banking industry, quite high, because Ghanaian borrowers, both individuals and corporate, just don't like paying back, their debt. So it is not a walk in the park asset class. A lot of due diligence, needs to go into it before we allocate. Otherwise, it would come back, to hurt us. However, when we get, a good issuer, we are happy to back. And I'm very happy to say, we were a strong advocate for the Kasaprekun bond. And we hope, they repay, the faith we had in them to invest, that amount of money in that particular bond. On Eurobonds, now Eurobonds basically, offers very limited opportunities post-DDEP restructuring, right? In a stable currency regime, they provide, very little advantage. If our regulator would allow geographic diversification, right, as seen in very, forward-looking pension system, we would reduce our allocation to Eurobond. And the very reason why they restrict us from investing, globally, I guess, it is to protect FX, to avoid, excessive demand, for FX. Meanwhile, when we want to buy Eurobond, we still, buy with FX. So it really doesn't make, much economic sense, in my view, right? So it doesn't really, given the stability, we are seeing, and the reduced, interest rate because of the restructuring, it doesn't offer much advantage. However, given our history of currency depreciation, where the CD has lost 93% of value since redomination, I heard that from AJ with Bernard, on Monday, right? And the National Pension Regulatory Authority restriction on external investment holding Eurobonds still serves as a defensive strategy against extreme macroeconomic events. Mark Twain is credited with saying, history doesn't repeat itself, but it often rhymes. Howard Marks, one of my investment mentors and icon, uses this quote to highlight that whilst historical events don't occur exactly, similar patterns in human behavior and market cycle often emerge. And I hope the recent stabilization in the CD persists. But the current scenario feels like a sequel to the 2017 story. 2017 was very good. And I pray hubris does not undermine the reset agenda. Right? For the sake of time, I'll move to our view on commodities and private market. We are likely, when I say we, Axis, subject to correction, the largest holders of the ABSA New Gold ETF listed on the Ghana Stock Exchange, whilst the industry and our fund managers overlooked this asset class. Credit goes to Amos Akoto, formerly of SIMS, and ICAM for aggressively accumulating this asset class for our funds way back in 2020 around the COVID pandemic, right? And we've made over 300% in that particular asset class since then. And I feel there will be no turning back on that particular asset. Gold historically has performed all major asset class except the US stock. So from 2014 to 2013, whilst the S&P did 13%, including dividend, gold did about 6.2% on a dollar basis. So we'll still allocate about 5% to 10% of our asset to gold. Private market or alternatives are fast-growing asset category globally, with pension funds mainly driving this trend. In Ghana, where public listings are often avoided, and listed securities, both bonds and equities, are scarce, private market investments are the only way pension funds can benefit the real sector, but most importantly, generate return for our contributors. Many of our fund managers on our continent are untested in terms of raising multiple funds, right, and generating that much alpha, for investors. Most of the fund managers are on their first, fund. So we love, this asset, based on our view of that particular asset class, hoping that our general partners will prove reliable, right? So we seek integrity, we seek hard work, we seek rigor, and we seek active management to make this allocation worthwhile. And I believe if they repay our faith, right, in them, the sky is the limit for them. We can build our own versions of KKR and Blackstone right here in Ghana. In the next few slides, I'll present the asset allocation of 6 of our schemes without mentioning name for confidentiality. Right, when we studied for the CFA, we read that 95% of investment returns comes from asset allocation, right? And the 5 comes from security selection, trading, and all the movement we do on our funds. Right, Vanguard did a research, and some of the best performing accounts they had belong to dead people, right? In investment, sometimes do nothing is the best approach. And I believe asset allocation, once we get it right, will generate, return. Right, so this is, I'll disclose this. This is our, CEDA, pension fund, our tier 2. Right, we've been bullish on equities, since. So you see our equity allocation has increased from 2019, when the industry allocation was sub 3%, currently about 11%, right? Our returns have been quite volatile because we have some heavy allocations to USD. So 2022, when the currency saw over 50% depreciation, our scheme, benefited because of the dollar position, right? And then because of our holding in DDP Eurobond, right? Whilst the holders of our local currency bond, did, well. The restructuring, hurt us. Hence, the 17% return in 2023. But then over a 5-year period, you'd realize we've done about 22.54%, 26 over the last 3 years, and then 27 last year. This is one of our schemes we administer. Also with, a good, equity allocation, right? From 3%, gradually, they've rounded up to about 11, and this is the, return. That is another one with a healthy equity allocation. That is one with an okay equity allocation, and this is the return. And then this is one 4.4% equity allocation, still heavy allocation, to Government of Ghana securities and fixed deposit, and this is the return. And lastly, this scheme has barely any, equity allocation. The key takeaway, from this exercise, as I mentioned, asset allocation is everything, is that schemes that had moderate allocation to equity, that were fairly diversified, with allocation of between 8% to 12% to equities, outperformed those schemes with less than 3% equity allocation by over 6% in the last year, 4% over the last 3 years, and 2% over the last 5 years. Right? And if you understand the power of compound interest, you know what 1% outperformance over 10 years, 5 years can result in. Imagine the potential of our pension scheme if MPRA will allow just 10% allocation externally, in spite of the opportunities that abound internally. It just makes a lot of sense to diversify, as it is the free lunch when it comes to investment. Right? We would generate so much return for our members. I'll conclude by saying, let's not underestimate the power of sound asset allocation and diversification, because 1% return difference over 20 years, 30 years would be the difference as to whether you can afford your so much cherished vacation when you retire. Thank you very much for your time.
Wow, that was nice. I think we should take some questions, right? Should we? Right. So Nana and Gideon, put your hands together for them again. That was really good. Maybe a few minutes. So can I get a couple of mics? You just mentioned your name. Clarification, disagreement, debate, or just giving them funds. I'm happy to take all. So let's take like 3 questions, then you try and answer. So start, yes, sir.
All right, sir. Thank you very much. I'm Isaac Ahaji from Ghana Port and Harbours Authorities. Yeah, just a quick one on the ABSA new ETF. I just want to know why exactly do you think we should go into the new gold? And then I also want to find out whether if ABSA is the only bank offering that in Ghana. Thank you very much for the wonderful presentation. Thank you.
Thank you. Isaac, we'll take 2 more. So, just behind you, madam. Madam, okay, yes, at the back.
Thank you very much. I'm Mr. Jato from Kolebu. The president
Mr. What?
Jato.
From where?
Kolebu.
Thank you.
The president of Kolebu Senior Staff Association.
Yeah.
Yes, my interest is got to know whether we are even limited by legal terms, where we are only investing in some few areas to the extent you are going to the district governance securities. But we have a very lucrative area for like the oil industry, the extractive industry, where it goes. We allow foreigners to come and take our resources away, where that place is neglected, where the resources could be channeled in those ways, where the returns, I think, is far better than where we are only, the farm managers are limited to. If it is illegal, this I think we can explore a means of way of lobbying for it to make amendment to it so that we can channel our destinies.
So you're asking if the sectoral asset allocations are legally
bounded.
So it's a legal restriction.
So if there's a legal restriction to rate,
or regulatory.
Yeah, it's to rate. Now, 5, that is restricting them. Then now today is the time for us to begin to lobby for them to amend the law, because the whole country is now going into the reset form, whereby we can invest into our own natural resources so we can own it. For instance, the extractive industry, the gold, you can see what they are doing to our water bodies.
Yeah.
Foreigners, they carry the things away. The oil industry is another area.
All right.
Just
so that's clear. They'll comment on that. Thank you. Stay in that aisle. Yes, sir.
Thank you very much. Andrew Sauja is my name. Ghana Cocoa Board.
Okay.
The second presenter made mention of diversification to enjoy better pension in the future. So I would like to ask, mortgaging for staff, what is his position on it? As we're doing contribution at our working age, is it prudent for access pension to set up a modality for staff to start enjoying mortgage prior to their pension?
Thank you.
Thank you.
Thank you, Kobo. Is there any more in that lane? Madam, can come forward. There's a gentleman, Thomas Esso. That's your name. Go ahead.
Thank you very much. My name is already mentioned by Mr. Avle. So, Nana, I just want to find out, looking at the dynamics on the secondary bond markets, with the bonds trading at discounts, do you think, all things being equal, it could be a strategy for a fund manager or a trustee who is ready to hold to maturity to start mobbing the excess supply on the market, looking at the discount at which it's trading now?
So please handle these 4 in the middle aisle. When you're done, we move to the next aisle. So Nana and Gideon, thank you.
All right, thank you very much. So I'll take, the new gold, question. So it's an ETF. ETF means exchange traded funds, right? And purchasing that ETF gives you exposure to gold. So you can invest in gold either by buying the physical bullion, right? When you buy the physical bullion, you have to contend with storage issues. Or invest via a paper asset, and that's where the new gold comes in. You can also, invest in a gold operating company. When you invest in a gold operating company, you are exposed to either the competencies and the incompetencies of the management team. If they generate profit, you get, dividend. I feel exposure to the raw commodity is an ideal, strategy. So buying that ETFs gives you unfiltered exposure to gold. When gold price, goes up, you make money. And this year, as we speak right now, gold has rallied over 23% year to date because of my best friends, policies in the US. Coupled with currency, right? You live in a country whose currency is that volatile. Gold provides added advantage. So in 2022, when the cedi depreciated by over 50% and gold, did, close to 21% return. Our ETF, holding, generated in excess of 90% return. So it is pure, exposure, to gold. And currently, ABSA is the only provider of that particular asset class in Ghana, right? It takes so much to be able to put together such commodity ETF, right? So every purchase of that ETF has a gold back in it, right? And the gold, is saved or stored somewhere in UK. I think, our fund managers and our banks could have the capacity, but then it takes time. So yes, ABSA is the only provider of that. Individuals can explore that. You can buy, the Bank of Ghana, new gold coin. It gives you the same exposure. However, if you want to sell that gold coin, you need to find Nana, right, who is willing to buy, right? But once, you buy the ABSA ETF and you want to sell, ABSA, stands ready to provide liquidity, right? So they would sell off you if there's no buyer and vice investor, though there's much liquidity over there too. And then on the bit about mortgage, for staff, yes, ideally the pension law allows contributors to use, their pension, right, as collateral, for mortgage. I think, our banks, should come to the table, right, in coming up with, product, mortgage product that will facilitate, home ownership by leveraging on your pension scheme. The hard truth is our macroeconomic context does not make it conducive, to afford mortgage. In Ghana, trust me, 95% of mortgage underwriting goes to bank staff. They enjoy, concessionary rate. Most of us in this room cannot afford, mortgage. To afford a $50,000, home, right? You should be earning in excess of 40,000 cedis because of interest rate challenges. How many of us, earn 40,000, cedis plus, right? And where can you even buy a $50,000, dollar home? So we are hoping the reset agenda will consolidate so that myself and Pankofi, can afford, mortgage at 10%. Otherwise, forget, you can use your pension fund as collateral. Your income cannot service the mortgage. It's blatant truth. And then the secondary bond. Yeah, we saw that opportunity. We wanted, to go, aggressively on those DDP bond, last year. But the concern for pension fund holders, we had, a sweetheart deal, right? We had a sweetheart deal. And those bonds are not, tradable because it is good, right? So if you want to buy or pension fund want to buy, then it would be, what the bank, held, right? And how do we contend with the valuation and the admin, side, right? So that was the concern, our fund managers, had, right? Because pension fund had a very good deal during the DDEP, and the other, holders, the banks, were given a raw deal. And those are the bonds available. When you buy, how do you deal with the valuation? But yes, I agree. There are opportunities. And guess what? The foreigners are aggressively in the market, looking, for such. So maybe we should, given where Treasury bill, rate is, it is really a no-brainer, to aggressively buy. They say, you buy when people are fearful, right? So that's about that. Gideon, you can take.
Okay, so I'll take the question on whether we are limited by regulation to go into some or to invest in some sectors. I wouldn't say we are limited, we are rather guided. So we have the NPRA guideline, investment guidelines, which is the manual for fund managers and pension funds to invest. If it's a sector that you are looking to invest in, you can look on the stock exchange whether there is an exposure there that you can participate. If it is mining, there are mining companies that are listed on the exchange. If it is not a public listing, we have, a guideline way of doing a direct equity investment. You can't directly do that as a pension fund. There are other vehicles you can join, like private equity investments that you can join to do that. So if you are interested in a certain sector, you may just, and it doesn't exist on the stock exchange, and you are finding it hard, maybe you can find a private equity firm that has a fund that builds exposure to such sector, and you can go through it. Thank you.
So there were 4 questions asked. You've answered 3, but I don't remember the 4th question. Whose question was not answered? Or you answered 3, yes, and he answered 1. Yes. Wonderful. Let's come to the second aisle. Can you come forward, madam? Who has the mic? Yes, sir.
Hi, my name is Martin Nenshi from M&J Audit Solutions and Consultancy. Just a couple of questions. In one of your earlier presentations, you were talking about corporate bond activity being on the increase. And my question is, why is this the case? In the past, we've had quite a lot of schemes that invested in the corporate bond space. We've had a couple of failures with the likes of Edendale and also bond financial savings and loans, which meant that a lot of trustees were reluctant to invest in this space, especially without any collateral. I know you've talked about Casa Preco, but my question is, what is given this increased activity in this particular space?
Thank you.
All right. My second question is, again, when you were talking about the multi-asset strategy, I would like to think that this only applies to the Ghana space, but just in case I'm wrong, does this strategy also include Africa and the rest of the world? Thank you.
Thank you. Still within that area, Madam, there's a hand in front, first row. Please raise your hand so she sees you. Yes, sir. Sorry. I think somebody put the mic off.
It's on now.
Wonderful.
Okay. I'm Robert Amponsan-Yeboah from Stanbic Bank. I would like to marry Afiye's presentation with that of Nana Riafe. So basically, one of the reforms which Afiye talked about was revitalize of local government or local government instruments, talking about municipal bonds. In Nana Riafe's presentation, I saw that local government instrument was bearish, red. I think that's the only thing there that you were bearish on. But Afiye mentioned that the Chinese economic miracle came about because of the local or municipal bonds that were introduced, and that was used to build up the economy. Why are you bearish in local government instruments? You've given a reason, but are there more reasons? Do we have that in the market? Can we look at it, and how can we revamp that particular area?
You'll be a very good morning show host. You are pitching a man against his boss on the same platform. Good job. Any more questions in that aisle? I think we're done there. Any more here? As for these people, they are not part of the conference. They are at the UN General Assembly. They are in a different program. All right. I think there's a hand here. There's a lady here. All right. Okay. And then the extreme left. Any questions? If I haven't seen your hand, you can wave. You guys are fine. Okay. Thank you.
Hi. Good morning.
Morning.
My name is Benjamin Nathan Ochre from GCB Capital.
Okay.
That is a very good presentation from ASIC's team. I think that this very conference is one of the best we are having. Okay.
You can put your hands together. Thank you.
Yes. And actually they are being the leaders in the industry. We like that. My question is on the FDs. So you mentioned being bullish on FDs. So with that, I wanted to ask, we had a cleanup about 7-8 years ago, and then trustees and other investors are very skeptical in going there. So with that, where are you looking at? Are you looking at the banks? Are you looking at savings and loans, microfinances? Where are you looking at? And when you are doing your analysis, aside the financial statement and the ratio analysis you do, what other things do you really look at to say that, okay, your IC, you are trying to make a case to your IC that this is a good place to go? Thank you.
Thank you. Madam?
My name is Anastasia. In Gideon's presentation, I think one of the slides showed that in 2024, industry had a strong growth. Can you give us the drivers of that? Also, Nana Riafe mentioned that he is bullish on non-financials corporate. Now we know that financials actually have a diversified portfolio. So why that stance? Thank you.
Thank you. So that will be it for the questions. Gentlemen.
Sure, thank you. So I'll marry, Martin's question with Stacey's, question on the corporate, bond. So yes, we've had, some defaults, Edendale, bond PBC. And for me, right, default, shouldn't stop allocation to a particular sector. We learn, from those defaults and then make, correction. And that is why in my presentation, I mentioned strong issuers, managers with integrity, right? And then proper, due diligence. What were the lessons, I learned, from the default you mentioned? I asked myself, for those, 3 particular issuers, if they had come on the market and issued equities, would I have gone ahead and then bought the equities? And for all the 3, it was no. There's no way I was going to buy PBC, right? Bond, I don't think so. Edendale, in that state, no. Why did we think, their debt was going to be safe? So internally, we apply, straight equity analysis for all potential, bond issuers. And if you don't meet our equity screen, right, we will not, buy. So that is, the learnings and the lessons, from the spate of default we saw in the industry. We bought Casa Preco, because the numbers, made sense. They had, challenges. Obviously, their challenges, stemmed, from aggressive, growth. They took on so much debt, to expand. And that has been the problem with most Ghanaian, companies, right? We always want to grow ahead of ourselves. But then we looked at the numbers, we liked it. Thankfully for us, there was a comparison on the Ghana Stock Exchange, GGBL. GGBL didn't have enough debt on their balance sheet. But then if you check their inventories, their payables, right, you'd realize they rely mostly on their parent company for financing. So really, in terms of the capital structure, they were basically, like Casa Preco. And like I said, the numbers, made sense. We love the stories. And we feel, to make, change, right? You can't sit outside, criticize their numbers, criticize, management, when you don't have, your money in there. So yes, we backed Casa Preco. And if you follow them, they've made, changes in their corporate governance, etc. It's early days yet, but we are very, confident they'll pay back, our monies. So that's about that. For the reason we prefer, non-financial, corporate, is, once we understand the business and can track, cash flow, we know the sources, of income. Casa Preco, it is what? Water, Fanta in quote, and Akpeteshi, right? Yeah, and Ghanaians, we love parties, right? Yeah, those are consumer staples, whether DDP, whether currency depreciation, we'll still drink, right? So, even COVID, so it makes sense. For the non-financials, if you've listened to the stories, it's been on non-banks, right, that are on the market. And there's problem, with MPLs. I hear people take, loan, and they travel out, and they don't pay. So we would want the dust, right, to settle before we reconsider. That is not to say we are not allocating at all, but then we are very deliberate in allocating, to that. And then the FDs, I'll touch briefly on the FD, and I'm sure Ifriye, mentioned that. And just last week, we're having a discussion with my colleague, Ike Buama. Why can't we list our FDs, right? Barclays Bank, Absa now, they've been issuing, these NCDs over the last, couple of years. And those NCDs are tradable on the CSDs, right? Right now, sitting here, I can log on to a global brokerage platform and buy JP Morgan, fixed deposit, right? I can buy a Schwab's or a Bank of America, FD, which is, listed on their market. And I think that is where we should, get to. Once that is the practice, the information asymmetry problem where, banks are hiding, their financials can be resolved. And in terms, of what we look at, right, we rely absolutely on our fund managers. My board chairman will not be happy. But then when it comes to FD, we go with what our fund managers, tell us. And they have their investment, criteria. But then obviously, capital will be a consideration, and then ability, to pay back. Thank you.
Okay, so I'll take the question on the drivers of our GDP growth for 2024. From a sectorial perspective, it was largely supported by the industry and services sectors. If you draw down the industry sector, a large part of the growth came from mining and quarrying, and then the services sector, I think the financial and insurance sector. So that were largely the drivers for the 2024 growth. Thank you.
And the last one on the local government, instrument, the reason why we had it read, I think we really had something, going on for us, right, on that particular asset class. We had a Dachi bond to help improve school infrastructure. We had the ESLA, and it didn't make, let me be blunt, sense, for the former finance minister to include that in the DDEP. I know, William stood on principle and didn't submit, that bond, for the DDEP. It didn't make sense, right? We had something absolutely great, going on for us. And now people would have a rethink investing in such, asset class. That is not to say, no. We had it read because there's really nothing happening over there, right? And I guess, it would take another 7 years for us to forget, the hurt of the past, right? So, that is, the main, issue. The cocoa board, defaulted. Sorry to our cocoa board, people. Yeah, and then we included such, a special purpose, vehicle like Daci and ESLA, which had the cash flow to service its debt to the DDEP. Killing, capital market, we've told, to build. So it will take a lot of effort.
All right. Thank you very much. Put your hands together for them. Thank you, gentlemen. Gideon Amweninche and Nanawi Afebuama. I think if your portfolio is with Axis, it's in safe hands. It's fair to say this. Great job. So I'd like to bring up our keynote speaker. Just give me a chance to give 3 paragraphs on him. The rest he will show by what he says. So we're very proud at the 7th Axis Pension Strategy Conference to give you an international keynote speaker. I think you should put your hands together for that. We are internationalizing. Now, our keynote speaker is a prominent and seasoned figure in pensions industry in Botswana. He has over 34 years of experience and has played significant roles in reshaping the retirement funds industry in Botswana. Now, his work in pension fund management administration and advisory service, and is arguably the longest actively serving individual in the retirement fund servicing and employment benefit industry in that country. His degrees in economics and accounting in the early 90s, began his career at a leading life assurance company, rose through the ranks, and some of the companies include Botswana Life Insurance, Barclays Pension Management Consultants, Time Fund Managers, and of course, Alexander Forbes Financial Services. He was also a founding member of the Botswana Pension Society in 1994, chaired the society for over 10 years, and contributed to its management and technical committees for over 2 decades. Post-retirement, he continues to provide technical support to Alexander Forbes Botswana. He's also undertaking some special regulatory assignments on behalf of the Non-Banking Financial Institution Regulatory Authority of Botswana to turn around distressed life insurance companies. And the reason we are happy to have him is that Botswana and Ghana have been very similar. Even though we are 32 and they are 2 million, we both speak English. You can say we are both resource-intensive countries. So what gold is in Ghana is what diamonds are in Botswana. So there's a bit of similarity there. So ladies and gentlemen, please help me welcome our keynote speaker for the 2025 Pension Strategy Conference, Paul Masie, Chairman of Alexander Forbes Botswana. Keep clapping.
Good morning, ladies and gentlemen. My name is Paul Masie. Let me give you a bit of background, because a lot of people ask me how I ended up in pensions. And I told this to Efree the other day that, in fact, the gentleman who put him in touch with me, they lived a street behind us. So his brother worked for an insurance company. And then I went there to gate crash an interview. I wasn't invited. It was a life company, and they were looking for trainee graduates in the life and pensions division and the short-term insurance division. There were 13 people. The 13th didn't come, and I became the 13th. They wanted 3. I was one of the 3. That's how I ended in pensions. So what I'm going to do is, I can't miss an opportunity to tell you a bit about the next best place after heaven, which is Botswana. And then we'll go into the retirement funds industry, the global market performance, Africa country performance, and then final takeaways, which are really for you to decide what you want to take away. I can't tell you what you need to take away, but I'm sure that everything that I'm going to speak about will make logical sense. So Botswana is one of only 2 countries in Africa that has a flag that does not have the color green, red, or yellow. Can anybody guess which the second country is? It's Somalia. But anyway, that's our coat of arms. Pula is rain in Botswana. Botswana is semi-desert, and there is very little rain, so we like shouting Pula, hoping that it will rain. And it's home to the Okavango Delta, which is one of the World Heritage Sites, one of the few inland deltas with probably with the highest concentration of wildlife in one area. We have about 140,000, because some migrate, 170,000 elephants living in that area. If you want some, you can come and get them, because those things are very destructive. It's a landlocked country. We also got British or independence from British rule in 1966. Became a democratic state, and we share a border with 4 countries. So all the borders that I'm talking about, at one point, they're literally within a kilometer of each other. It's a very unique setup. We have a population of 2.48 million. Our currency is called the Pula, and it was introduced on the 23rd of August in 1976. When it was introduced, and I've highlighted this in red for context in the next slides, 1 Pula was greater than $1. So 1 Pula was equal to $1.15 when it was introduced. So we'll park that red text for now and refer to it later. Diamond mining, so I mean, I'm not going to go through them individually, but our biggest, and this is in order of contribution to GDP, our biggest source of revenue is diamond mining, followed by tourism, agriculture, manufacturing. Our official language is called Setswana, and the nationals are not Botswanan or Botswanian, they are Botswana. And there are only 3 countries in Africa where this happens. The rest, you are Ghanaians, South Africans, what have you. Okay, so back to business. I hope you guys will come to Botswana someday. So the retirement funds industry in Botswana is, I would say, relatively young, and I say relative because I'm comparing it to possibly the closest that we were benchmarking from as our industry grew, which is South Africa. They have an act which dates back to 1954. Our Pension and Provident Funds Act, as it was called, was first enacted in December 1987. The regulations came in 1988, and some of these, and the regulations had compulsory preservation. In other words, when they were first introduced, if your benefit was greater than a certain amount and you left service, you had no option to take it. You have to defer it until you get to retirement. That's part of the reason why the assets in the country have grown, because it is not everybody that resigns and takes their benefit and goes and buys a car and forgets to insure it and writes it off. The money, if it is beyond a certain threshold, could be in a pension fund for the next 20, 30 years, but continuing to grow. There's a specific document that, from the Income Tax Act that deals with how these benefits can be commuted. But part of the reason why the assets have been able to grow very quickly was because of the compulsory preservation contained in the legislation. So in 1995, these regulations were amended, and then in 2008, the Botswana Pension Society decided to lobby the government to change the laws, because there were a lot of absolute numbers referred to in the Act, which obviously become outdated. I mean, 20 years later, if you're still referring to an absolute figure, that figure has no significance at all. So in 2008, the regulator agreed to allow the industry to make submissions on what they think should be changed. And here's another thing. I sense that there's a bit of boxing here and there between the regulators and in Botswana, it's quite different. The regulator sees this as a partnership with the service providers, because there's no them and us situation. Where there's harmony and a consistent understanding of what you're trying to achieve, there will be progress. So there's a lot of support that the industry gets from the regulators. Yes, they regulate, and they're supervisors. They have to do that. It's their function. But they are always working together towards achieving a common goal for the benefit of the members. We are all, and I say trustees, very generically. This includes investment managers, member trustees, employer trustees, custodians, bankers, and what have you. We are all trustees because members have entrusted us to manage and look after their money. It's not our money. And we shouldn't be doing favors to others to try and please them by having this money and putting it wherever we want to put it. It must be well thought through processes. So the regulator, all I was saying is that is very supportive of the industry, and they understand. In fact, they rely a lot on the industry to tell them what needs to be updated or changed. Or, you know what I'm saying? So there's no boxing like I watched the last match. So yes, the review was in 2008, and then it took a bit of time, because I mean, you all know, to change a law is not, especially in Africa, you don't have presidential directives like in other countries up there. So the act was then came into place in 2014. It was then called the Retirement Funds Act, no longer the Pension and Provident Funds Act. A couple of years later, 2022, the same act, the industry was requested to, the 2014 act, the industry was requested to update or provide updates on what should change, what could be amended, and a new act came in 2022. So they see that there is a need, because part of the problem is, or part of the problems that retirement funds had was they were being requested to do certain things to comply with AML laws and what have you, but those were not contained in the Act. So technically, the regulator couldn't say to them, look, I'm fining you for this. So they had to update all of those. So we have a new act called the Retirement Funds Act of 2022. There's no compulsory national social security fund in the country. No national health insurance fund. The only thing that we have at a universal level is a state old age pension, which kicks in when you're 65. It's not means tested. As long as you're 65, even if you're a billionaire, you still qualify for that small amount. So, investments. What can I tell you about Botswana's investment dispensations? The first time investments were regulated was in 1988. Prior to that, you could do your own thing. Nobody cared. And when they were first introduced, pension funds could invest a maximum of 65% offshore. Offshore meaning any country outside Botswana. And then in the mid-90s, it was reduced to 55%. Now, here's the story. You see that it was reduced and increased, both mid-90s, because there was some confusion on which became effective on the two. So in those days, the central bank issued what we call Bank of Botswana certificates, and these were yielding close to 17% at the time. And our government received a lot of money from the central bank in the form of a dividend, being the differential between what they were paying the banks and what they were getting out there. So it was reduced to 55%, and then the asset managers willingly obliged. They brought the 10% back to Botswana. They parked it in Bank of Botswana certificates, and inflation was like 8% or something like that. They parked it in Bank of Botswana. Why would you be worried if you are getting a real return of 10%? You don't have to do anything. So at the end of the year, when the government was expecting to receive a dividend, it was far less than what they were accustomed to. Because all the managers gave the money to the banks then put it in BOBSEs, and then BOBSEs, the Bank of Botswana paid huge amounts of interest, the highest it had ever paid. And then somebody discovered that this is actually a problem. Having this money and us getting a smaller dividend is not a good idea. So they quickly changed it to 70%. Before the ink on the 55% could dry, it was changed to 70%. And that's where the 70% came from. At this stage, I'll go through the actual limits as they are today. So the other provisions that exist in our legislation relating to investments was that the minister can pass, there's provision in the Act for the minister to pass a regulation for funds to invest no more, it doesn't say no less, no more than 55% in government bonds. Now, the 55% is the maximum that the minister can say you should invest, you can invest in government bonds. You can invest zero in government bonds if you want to. 55 is the maximum. But this provision has never been used. They've never passed because everybody has just operated sanely. A pension fund cannot invest more than 5% in the business of the employer. And I'm going to highlight the word employer here. No fund can borrow funds in excess of 25% of assets. I don't know under which situation a fund would be borrowing money from external sources. And then in 2017, we saw the introduction of the first set of documented investment rules that applied to retirement funds, Prudential Rule Fund 2. In 2022, the non-bank financial institutions regulatory authority issued a directive. We don't know where the advice came from, but it looks like they forgot to go and consult the industry. We woke up one morning and then we were told, oh, by the way, every fund has to have a maximum of 50% locally. When at the time, the majority of them were sitting at about 60-65% offshore. So we then looked at this and said, but this is not going to work. We're going to bring this money back here. It is going to go into bank accounts because our investable universe is not large enough. And what it's going to mean is that members are going to be disadvantaged. Are you happy with us telling the members that you would like us to sacrifice those good returns and put their money under a pillow? We are happy to tell them that. And they said, okay, that's not a good idea. Let's rethink this thing. So the directive was then revised in 2023 to stagger those repatriations over a 5-year period. This is, so back to 2017, it was the limit was 70% offshore. But the majority of them were actually around 65% or 60%. No, not the actual 70. And the broad limits were you could invest up to 30% in foreign cash, 50% foreign bonds, offshore equity 50%, property 10%. Now, there's a limitation on the amounts that you can invest per issuer. So if, for instance, in foreign cash, it's 30%. It's a maximum of 5% per issuer. So in effect, what it means is you can invest, you could do it up to 6 different entities at 5%, 5%, 5% to get to the 30%. Now on property, the retirement funds are not allowed to invest in direct property outside of the country. They are allowed to invest in companies that are either collective investment undertakings or listed property companies. And the reason for that is because you don't want to be invested in some property somewhere and then there's a war and then the whole country is demolished and then you have nothing. It's easier to sell those instruments if they are listed instruments on stock exchanges. So I mentioned that the prudential rules were then amended and staggered. From 2023, the broad offshore limits are 40%. So this increased from the 30 that we saw earlier. Foreign cash increased to 40%. Foreign bonds 50%. Offshore equity, this hasn't changed. Property also hasn't changed. And this is the 5-year plan. This is the 5-year plan of what it looks like. By December 2023, the total maximum you could have offshore was supposed to have been 62%. Last year, December, it was supposed to have been 59% that you could have as a maximum offshore. Now, here's where we have a problem. It's about 3% reduction per annum. The offshore investment performance is outstripping the 3%. So it is difficult to even try and meet this. You understand? So you are planning to bring back 3%. You've identified where you're going to slot it. Call it 2 billion. At the end of the year, when you're supposed to repatriate it, the amount that you're supposed to bring back is 6 billion because of the performance. But the beauty about it is, as I said, the regulator understands that you can't just forcefully bring the money and then park it in a bicycle factory somewhere, or, So there are those challenges. It's a good challenge, it's a beautiful challenge to have, to the extent that it's creating value, it's still creating value for the members. And I can see ourselves having this. We had the same problem in 2023, just after COVID, when markets started shooting up. We have the same problem 2024. We are going to have the same problem in 2025. And most likely in the next couple of years. I don't know when the next American elections are, but we will definitely have that nice problem over the next few years. And again, it's not the end of the world. Where it's not being met because the performance is outstripping the percentages that are supposed to be brought back here, you know what, nobody's going to die from that. The members will benefit. Now, I've put up this thing to show you just generally what the broad investment guidelines look like, because they're not very prescriptive. If you want to, there's a website where you can access these documents. It's the regulator's website, www.nbfira.org.bw, and then go to retirement funds. You'll get the full document. It's a 22-page document. But this is just an extract of what it roughly, what it looks like. So if you look at it's got asset categories: local cash, total limit 20%. So the total cash exposure, if you look at the blue line at the top, the total cash exposure that you can have is 60%, split between 20/40 local and foreign. Government bonds, including, what did you call them, local authority bonds, you can have 100%, but nobody goes to 100%. In fact, I was looking at, I was showing a document there out there where it shows that the average pension fund in Botswana has 60% in equities. That 60% is split 35% roughly in offshore equities, 25% roughly in domestic equities. Bonds, 10% offshore, 10% local. That 10% local also includes government bonds. It's a combination of government bonds and corporate bonds. And then there's cash and private equity and alternatives, which are 2.5% to 5%. So our guys learned that these things are actually not free money. At some point you have to pay them back, and you have an obligation to pay the coupon. It is not a social service to issue a bond and get money from a retirement fund. You're going to have to pay it back, and you have to pay the coupon. So our guys picked that up quite some time ago. That's why they try and avoid receiving money from retirement funds. They would rather it's somebody else out there. But it makes sense. Like I say, these things are actually loans. It's not free money. So that's basically what it looks like. I'm not going to go into the numbers individually. So it's very broad and typically mirrors what one would expect of any growth-orientated retirement funds industry. The only way that you're going to create wealth and allow the CFA guys to use what they learn. You can't send these guys to school for nothing. They must apply what they learned. The only way that they can do this effectively is if the parameters are broad enough to enable them to do that, including the asset selection. What is the point of not allowing them to do what is known and accepted as the best way to grow retirement fund assets? Yeah, I said, so I mean, even building society shares, these are very, it's neither here nor there. But those broad allocations are the ones that mattered most. The roughly 60% in equities, and 10% bonds and 5% cash. Now, between offshore and local, Botswana retirement funds, that entire, call it $10 billion, 55% of it sits in offshore markets. Only 45% is still local. But the idea, of course, is to try and meet that. There has to be some motivation for us to bring it back. But if it ends up affecting members, then we're going to have to do something about it. So when these new rules were introduced, the previous rules didn't have references to alternative investments. They didn't make provision for infrastructure investments and for private equity. So these were the three new categories that were introduced in the prudential rules. So from a PFR2, this is the investment rules perspective. The regulator was trying to encourage the industry to broaden their investment structures, not confine them or restrict them, but to broaden them, in recognition of the fact that you can only create value for your members if you have a diversified portfolio. The other takeaway was the gradual repatriation, improved clarity on the three asset classes that I just showed you earlier, and there were a couple of adjustments to the general offshore limits. Now, I've been speaking about, do you mind if I turn this thing, because I keep having trying to aim it. So the references that I've been making to global asset class or asset classes becomes relevant in this next section of the presentation. So roughly, what we do is when we measure we've obviously got domestic indices for bonds and cash and what have you, but for offshore investments, mainly equities, we use the MSCI World and the MSCI All Countries World Index. And the composition of these is roughly 72% USA. This is MSCI World. 5% Japan, 4% UK, Canada, China, and the others. Then the All Countries World Index is very similar, but those are the percentages out there. So it takes the performance of the countries in those proportions when we use that as a benchmark to measure ourselves against for the offshore investments. I'm not going to spend time on this busy slide, but what I wanted to highlight was the second column from the right. The second column from the right that shows the 5-year performance. That performance that you see there, the 15.71, is in US dollars. So if you had a pension fund that had invested, for argument's sake, for ease of reference, say all of its money in a tracker fund, the fund that tracks the performance of these indices, your return in US dollars would have been 15.71 over the last 5 years in US dollars. Okay, if you want to know what it would be in cedi, just superimpose the depreciation against that 15.7. I don't know what percentage it is, but I think I saw it somewhere. But anyway, so the emphasis here is, it's there, it's in black and white. we know what's happening right now because this is at the end of March. We know what's happening, why there's that minus 1.22. Don't we? Yes, we do. A more summarized version of that slide is 15 years, 11, and again, this is in US dollars. Now here, this is in US dollars. It's 15 years, it's 11, 10 years is 10, 5 years is 14, and so on. I've put the same performance in Botswana Pula. So for a pension fund that is of Botswana origin and has invested in a tracker fund, let's look at the 3 years, for instance. In US dollars, it would be 10.75%. But in Pula, when you translate the return to Pula, it's actually about 17.4%. In all periods, when you measure it in Pula, it's double-digit performance. Now, put that in the context of a country where the average inflation, right now, is about 2.8%. Okay? So you are looking at, on average, a real return of 14% in some instances in BWP. The other index, the All Countries World Index, same thing. When you convert the US dollar performance to Pula, it becomes higher. And that, my fellow natives of the African continent, is one of the reasons why retirement funds in Botswana do very well. It is because they are allowed to invest in these highly developed markets. You know what, there's every need for development in our countries, but at what cost? So if you look at unfortunately if you look at the two bars, the orange one and the green one at the top, those are what the returns are in Pula. And the ones just that start where there's that 10% figure, that's in US dollars. So you see the disparity. The disparity meaning that in any language that you try and translate this slide into, you are going to get a positive impact from having been invested in US dollars or in foreign currencies. And that red block there was just after COVID, or during COVID actually. And they kind of tended to converge because there was very little trading happening globally. Again, another way to demonstrate this, the bottom part, the 467.27, is US dollars. The Pula effect is almost double since or over a 15-year period. So you almost doubled your performance, not by applying any rocket science, but by having it invested in hard currencies. I'm not saying anything about the CFA, guys. So we then look at our Africa currencies, and I've taken the top 10 currencies that, or at least what we believe are the top 10 currencies in African countries, and the CD is one of them. Tunisia, Libya, Morocco, Botswana, in that order. Okay, Lesotho, Namibia, and what used to be called Swaziland. These are almost 100% pegged to the South African rand. So in this slide, I just wanted to show them to you, even though they appear here. So it should actually be South Africa that appears there. So in the next slide, you will see that this is almost identical to what the South African rand is. I'll start, they say charity begins at home, so I'll start with the Pula so that you don't think I have anything against the cedi. This has been the performance of the Pula over the last 13 years against the US dollar. More often than not, it has depreciated over the years. So in more years, there are more years in which it was depreciating relative to those where it gained any mileage on the US dollar, which would be the bottom section. And oh, by the way, there's a reason why I keep putting up different years as opposed to one particular period. It's to demonstrate that regardless of which period you look at, you're still going to get the same result. I've used 13 years, I've used 10 years, I've used 5 years, I've used 12 years. And I think 8 years, some even go back like almost 40 years. And it's to demonstrate the sole concept that regardless of which period you look at, that you're going to get the same result or to the same conclusion. So if we look, now we're looking at 5 years, okay? In 5 years, the depreciation, the Pula has depreciated against the US dollar in 5 years. In 2010, sorry, in 15 years, it was in 2010 it was 6.95. Right now, it is 13.85. That's double. Okay. Since, remember that 1.15 US dollars that I showed you? It's 17.3 times since the Pula was introduced. So the Pula has depreciated 17.3 times over the US dollar. If you want to know what the investment performance is for your retirement funds, take that 17.3%, multiply it by those US dollar performance figures that I've been showing to you. And then it will tell you, it will show you what. There were years, I remember when I started working in this industry, there were years when it was common to get returns of 30, 40% per annum, compound. Because, you know, whether we like it or not, or try to be as patriotic as we want to, our currencies have always tended to depreciate against the harder currencies. It's a fact. We have to accept it. We cannot be overprotective and patriotic at the expense of generating decent investment returns for our members. We can't. It just doesn't work that way. 10-year performance of these countries: Tunisia, minus 35%, Libya, minus 75%, Morocco. And there's a reason why Morocco is 5%, is because it's pegged to two hard currencies, 60% US dollar, 40% euro. You understand? So Morocco, there's a reason why it's like that. Botswana, over the past 10 years, it's minus 29%. Seychelles, minus 8%. And Eritrea, there's a reason why it's a positive 2%. It's pegged 100% to the US dollar. 1 US dollar equals 15 Eritrean units. So it doesn't matter what happens. If the US dollar appreciates, so will their currency. You understand? But if you look at all the other countries or the other currencies that try and do their own magic internally, over time, you can see the picture. I don't need to speak in any other language other than English to show you that it is actually the truth. The cedi, minus 75%. Multiply this minus 75 or impose it into the actual performance of the offshore markets. You might not be able to sleep tonight if you try and do that. You can ask the CFI guys to do it for you. But you might not be able to fall asleep thinking about all the lost opportunities over the past few years. I'm sorry to depress anybody. This is, I'm preaching to the converted. You know what's happened. 13 years, 2012 to 2025, it was 0.59 to US dollar. Today it is 0.069, yes. This was as at the 28th of March, so 28th of April, so it might have changed, but I did read somewhere that it recovered quite a bit over the month of April, which is a good thing, but is it a long-term trend? I would argue not, not to depress anybody again. So in 13 years, there's been a differential of, measured against the US dollar, of 8.4 times. And we're only talking exchange differences. This assumes that you took the money and found an old lady somewhere in Texas and put the money under her bed. Not even investing it, just putting it under a pillow. This is just exchange differences. If you implant those exchange differences onto, or impose them onto the actual performance, then you've got a very big heart attack waiting for you. But you've got your consultants, they'll do it for you. They can try and show, they will show it to you. And I'm sorry if I have depressed anybody. That wasn't the objective. So the reality is that these hard currencies, they provide a hedge against inflation, and they offer greater stability when you have downturns, especially in the domestic markets. More often than not, there will be capital appreciation, there's high liquidity, and again, it brings in diversity and diversification. So these are things that it's not guesswork, it's out there, it's proven, and there are demonstrable markets that can show you that it actually happens. And you know, one of the last things that I want to ask is, it's a rhetorical question though, is why do we exist as trustees? And as I said trustees, I'm referring to everybody in a generic form, as somebody entrusted to manage or look after the money of other people. We exist to create wealth for our members. Is that correct? To the pensioners or to the members, we exist to provide protection to them in the years when they become vulnerable, when they can no longer work during old age, and provide meaningful benefits through providing bigger pension benefits. There's no point in being a trustee of a retirement fund when you know very well that you're actually fighting a losing battle. Your members are going to retire poor or destitute simply because of things that you know can be corrected. I'm more than certain that it must be heartbreaking knowing that some of these things can actually be fixed. But obviously there are constraints within the regulatory framework. But the point is that whether this money is sitting in London, Tokyo, or wherever, these people are going to retire in Ghana. They're not going to retire out there. This money is going to eventually come back here to come and pay these people. Yes, it might not be the same, amount that was sent to New York or wherever, but these people are going to retire here, but with much bigger benefits. because of the growth that they would have received from those offshore markets. We will still continue to have offshore assets, but if you ask me, 5% is way too low. Even the most conservative countries, take South Africa as an example, I think that is 20%. And those guys are some of the most conservative people. Remember South Africa's history. They came from that apartheid era where they wanted to keep everything domestically in order to help the government. But even they then went up to, I think it's about 20%, if my memory serves me well. 5% is might as well not do it. It doesn't make logical sense if the idea is noble and it is to create better benefits for members. From a government perspective, I mentioned earlier that if you have a high compulsory weighting to government instruments, effectively what you're doing is creating a loan burden for the government. Yes, it's okay for the government to take this money and use it for developmental purposes, but that money has to be paid back. It's not free money. Over and above that, there's the coupon that the government has to pay. Our government decided, you know what, we'd rather outsource this to somebody else. Let the corporates go and issue those things. If the banks want to issue loans, bonds, then they can issue those bonds, pay the coupons, but we don't have to pay anybody anything. We just get our little mining revenue, go and build another hospital, life goes on. We don't pay anybody back. You understand? And that's the way it should be. You're taking away an obligation, a burden from the government if there's a reduction in the allocation that is provided towards government bonds. I just heard earlier that pensions in Ghana are not taxable. In other countries, like in Botswana, for instance, if you are beyond a certain threshold, because you would have been receiving tax relief on contributions, and investment returns are 100% free of any taxes. There's no tax on investment returns for retirement funds. So if your pension is beyond a certain threshold, then you'd pay tax on just like any other PAYE arrangement. And what that has done is it has reduced the social obligation on government because a lot of people now have somewhat meaningful benefits because of the outstanding performance that we've experienced over the past couple of decades. And yes, we have destitutes in Botswana, but it's a handful of people. I am not aware of, and nor have I heard of, an instance where somebody died because they starved to death. Because there are very few people in that category, and the government takes care of them. So most of the people are fending for themselves. The average poor farmer in Botswana has 20 or 40 cattle. That's the average poor person. So, do offshore investments make sense? Do they? I'm sure they do. Because I've seen it, I've witnessed it. When I first joined the industry in Botswana, we had one fund, an internal fund called the Botswana Managed Retirement Fund. It was 1 million pula. And in those days, that 1 million pula was probably about $500,000 US. Yeah, plus minus. Right now, that retirement fund is worth 4 billion pula. That's the fund that I said was getting investment returns compounded of 27, 37, 50% year in, year out because of the offshore investment performance. 4 billion pula is roughly, divide that by 13.5 plus minus in US dollars. There are advantages for the members and for the government. But if you guys are to do it, I wouldn't advise any big bang approach, because generally that's when things go wrong. When everybody wants to bring back everything in a hurry, and then they get stuck with this. Okay, so what do we do with this money tonight? And then you get stuck between a rock and a hard place, because you've got the money, but now you don't know where to put it. It would probably make sense if, as an entire industry, and look, you have competitors. When I say you now, I'm talking to Access. You've got competitors, but when it comes to developing the industry for the social protection and for the protection of the members, you have to put those aside, those competitive issues aside. Your association of administrators should be able to sit down around one table and say, we would like to see 1, 2, 3, 4, and agree that is what you're going to submit, because there's more strength in submitting such proposals, not as one entity, but as an entire industry, to a regulator. They will more likely listen to 25 people than one person. If it's an entire industry saying, here's how we propose we do this, maybe we do it in incremental stages of 2% per annum over X number of years. You know what I'm saying? And you've got the guys who can do the numbers and crunch them and show them what it will translate into. That's the approach that I would recommend should take place. These market performance figures that I'm putting up there, it's public information. So you're going to also need investment consultants, or you've already got investment professionals. But do the other guys have investment professionals? I'm not sure. If they do, then maybe it's best for those investment professionals from the different companies to sit around one table and say, guys, how do we do this? And how do we demonstrate to the regulator that there's actually value in doing this? Like I said, there's the rocket scientists and then the CFA guys, then they'll do it. You know what I'm saying? So they will be able to demonstrate easily. It's not very it's not very difficult to see. It's there. It's in black and white. We're not guessing numbers. So my hope is that we've all been able to see the value that is created by allowing retirement funds to invest offshore, or at the very least in hard currencies. In Botswana, there's no exchange controls for corporates and individuals. It's only for retirement funds. If you want to invest your entire savings outside the country and ship it, you can do it anytime. You don't need to apply to a bank, to a central bank. Even corporates, doesn't matter. If you want me to pay you for your cocoa, and I'm in the same country with you, I can pay you in any currency. I can pay you in US dollars, euros, yen, whatever. Very little exchange controls, and it's worked very, very well for us. The initial expectation was that everybody was going to ship money outside the country, but that didn't happen, because there's nothing to run away from. Thank you very much.
I think we should take some questions. Did you like that? Oh, did you like that? Wonderful. Put your hands together one more time for him. I feel like I don't want to put a chair here for you to sit alone. It's like, so you can sit there and answer the questions, right? For me, I have only one question. How can I become a citizen of your country? Is it by birth or marriage or by, so that I got, because the decision is to move from the last few slides, when nobody's dying of hunger, the poorest person has 20 cows. You have 2.4 million people. So that's my first question. What is the citizenship pathway for a 43-year-old Ghanaian with a degree in economics and business? So we can discuss this. So that's my question. Yes, go ahead.
Okay, let me shoot it, then you come in. Thank you very much, Paul. I have two quick questions. Your schemes in the PPFA, what are the withdrawal rules pertaining to the schemes? Because I had pension and I had provident funds. What are the withdrawal rules associated? And then the second question is, how are you guys addressing the housing requirements of contributors? Because it's something that is very big here. People tend to withdraw their monies to try and build houses. How have you guys addressed that? Those are the two questions. Thank you.
Paul, can we take like 3 questions? So you lump the answers? Or you want 1 question, 1 answer? Let's take more. All right, so stay there, madam.
Thank you very much. My name is Michael. And my question was, is in a submission, it did mention that there is no exchange control on their retirement funds. I want to ask, does it, in terms of currency conversion, does it not put pressure on their currency in terms of it depreciating?
Good question. So that's Michael. Let's slip in one more. Anybody in that area? Yes, sir. Yes, you have the mic. Go ahead.
Hello. Oh, good. Thank you, sir. I have 2 questions.
Hey.
Just 2.
All right.
The picture painted is so beautiful.
Yeah.
My question is, has there ever been a downturn? You invested offshore, things went bad. How were you able to recoup the investment? And then the second one is, COVID came, and many companies suffered. How were they able to go through the pension industry in Botswana? How were they able to survive? So we can learn lessons in case tomorrow we face such thing. Thank you very much.
The citizenship. I can find your wife. Citizenship, you have to stay there for at least 10 years before you can apply. Or you can get married quickly to a local woman. Yeah. Okay. So we used to have what was the first legislation was called the Pension and Provident Funds Act. And remember I mentioned that there's compulsory preservation. So when it was first introduced, provident funds, you could still take everything out as cash. Even today, the same applies. With pension funds, when it first started, if your benefit was more than 2,000 pula at the time, you had to preserve everything until you got to retirement. That change, which I said happened in 1995, they then amended the commutation amounts for pension funds to say that if your benefit is greater than 5,000 pula, greater than 20,000 pula, you can take 25% of that benefit, or 5,000, whichever is greater. So the balance then has to remain in the fund until you get to age 55 minimum, or if it's an occupational pension fund, it's age 50. With provident funds, it's still the same. You can take the entire benefit out as cash, and it's all paid out tax-free. Now, we had an election last year, and you know, one of the biggest tragedies took place where I believe that these amendments that were passed to impress voters. Remember that 25% or 5,000 that I was talking about? It was changed to 50%. You could take 50% of the benefit as cash, provided that the remaining amount is more than 20,000. If it's less than 20,000, you take the entire benefit as cash. Now, what is happening right now is a lot of people that are retiring, A similar situation applies when you retire. You can take up to 50% of the benefit as cash. It used to be 33%. So what is happening right now is that a lot of people are actually taking out the entire benefit as cash and going to blow it. That destitution issue that I said is not so much a problem. I think it's coming in the next couple of years. And I'll send a message to somebody here to tell them what happened. Housing, our pension funds do, so there's provision in the Retirement Funds Act for pension funds to issue housing loans. But and that provision has always been there, but it is not being used for one reason. When you give a loan to a member from a pension fund, the natural expectation is going to be, this is his money, so I'm going to give him a concessionary rate. Is that correct? When you give him a concessionary rate, that concessionary rate that forms an investment return effectively to the fund, it's not just for that member, it is also applicable to the other members. So what about those members that do not have loans from the fund? That's problem number one. Problem number two, what happens if all the members decide that they want loans? That implies that you have to liquidate most of the pension fund and effectively make it a lending institution. Do you have the right resources and capacity to be able to assess all those loans? My quick answer to that is I don't think so. Banks are the most suited to do that. So what then happened is when there was that legislation review in 2014, we then allowed, or rather the regulator then allowed a provision in the Act which basically creates a situation where there can be a back-to-back arrangement. So if I am an employee and my employer can go to, I'll use ABSA as an example, and say, I am this guy's employee, I will guarantee this loan, but the employer guarantees this loan knowing that in the event that they default, they will go to the retirement fund, apply to get the amount that has defaulted on to be paid. It allows the fund to continue to invest and get those double-digit returns without necessarily saying, oh, after all, it's his money, let me be nice to him and give him a 5%, charge him a 5% interest. You understand? So it's easier to go to a bank and say, Mr. Bank, I have these 1,000 employees. They want loans. Can you give them loans using your money at a concessionary rate because you are sure that in the event that they default, you will be paid? Trying to do it directly within the fund is just asking for a big problem because you're going to convert all the pension funds into lending institutions. And then you're going to have big problems. The best way to do it is to do it with back-to-back arrangements with banks. It's their job. Banks should be, there's somebody from Stanbic. Yeah. That's how they make money. They lend money. Pension funds are not geared for that. A downturn offshore, of course. Offshore markets are not insulated from downturns. Remember what happened in 2001? Many pension funds experienced negative returns ranging between 12 and the highest that I remember was minus 23%. But, you know, I always say that human beings have got what I call selective investment amnesia. So what will happen is for 10, 15 years, you will get positive double-digit performance, right? And then there's that 1 year where it's negative. And then you forget about the other 15. and start doing industrial aerobics, complaining about how the markets, the managers have not invested your money properly. But it's that 1 year. And typically, it takes less than 2 years for the markets to recover, for you to be at the last base you were at before the negative performance. So those are expected. And if you ask your administrators to show you the trends, you can take these things back to 1900, and you will see that there is a trend. Roughly every 15, 20 years, you'll get one of these shocks. But unfortunately, you can't time these markets. Because if we could, everybody would be a billionaire, and we are not billionaires. So yes, in answer to your question, there are downturns, but I see them as short-term noise, because pension funds by nature are long-term animals. You can't measure the success of a pension fund or the failure of a pension fund because of one negative performance period in a 10-year period. You have to look at it over the long term. And most of them, you saw that slide that I showed you, the Botswana pula versus the US dollar over a longer period. There are more periods of positive performance than there are of negative performance. And if you add those up, they all outweigh the negative performance. I don't know if I missed... there was another one on whether the lack of exchange control does not place pressure on the Botswana pula. The Botswana pula is structured... They've got what I call the SDR, special drawing rights. It's a basket of currencies. And the structure of that basket is determined by our trades with those countries. So, for instance, the largest amount of trade that we have would be with South Africa. And therefore, I think it's 50% plus minus, somewhere there. 50% of the pula is pegged to what happens to the rand. And then there's another peg to the US dollar, a peg to the Japanese yen, a peg to the Chinese currency, and to the euro. So what in effect determines the value of the pula is the performance of all those currencies in the different weightings that that basket comprises of. Are we together? So there's very little impact that the fact that zero exchange controls exist has on the value of the currency. If the US dollar, the South African rand shoots up quite significantly, then the pula will also shoot up by 50% as an example of whatever the rand has shot up by. So it's a weighted average structured currency. It's not determined by one individual source of economics.
Right. Thank you. So I'd like to call my panel up in no particular order. Robert Marshall Benning. He is the founder and chief learning strategist for Temple Advisory. Let's put hands together for Robert. When I was in Legon, Robert was a couple of years ahead of me. He was the best graduating economics student. And then he went to Warwick University, so I followed him there. But I didn't collect any prize. But he's really good. Robert, thank you for being here. We also have another Robert. He's already spoken in a question. Robert Yeboah Amponsa, who is the financial controller for Stanbic Bank. Robert, please come up. And we are privileged to also have from Cocoa Board, Deputy Director of Finance, Yvonne Esson. Yvonne, thank you for being here, Yvonne. Cocoa is a very interesting topic for us, but I will not put you on the spot. As already alluded to, Ajay Boateng, CFA, Chief Investment Officer, Blackstar Advisors. They are into fund management. Ajay, thank you. Put your hands together for Ajay. And to be fair, Ajay has been shouting about this for a few years. Last year he said this, I think 2 years ago as well. So he's finally gotten somebody from outside to underscore what he's been shouting about for the past 3 years. So Jay, good on you. William Mensah, Executive Director, Bora Capital Advisors. They are trustees and fund managers. So I like to sort of categorize them so you know who's here. So Ajay is a fund manager in this context. Don't forget they are trustees, fund managers, custodians, and then we also have directors and then schemes that are part here. So Ajay is a fund manager. William is both a trustee and a fund manager. Robert is a trustee, right? And I think these clarifications are very important. We have from Yvonne is also a trustee, as is Robert Yeboah. All right. Now we have Nana Kwame Adodankwa, who is a corporate financial manager for GPHA. Nana Kwame, your name sounds like somebody we know. So if you had just added another one, it would have been Adodankwa something. Guys, is it possible to turn this so that I don't want to? I want to face them. So can you help me? So Nana Kwame is also a trustee. So let's just be clear. Who are the trustees? Wow. Where are the custodians? Fund managers? 2. All right, cool. Are we ready to set off? Have I missed anybody? Great. So this is what I'm going to do. I will exhaust the questions for our keynote speaker. Then I will take initial comments from all of you on what you've heard so far. So basically what you want to talk about. You've heard many things. A free is 6 pillars, what the 2 guys did and what our guest speaker has done. Then I will turn my attention to what next, right? After all we've heard, how do we, I think that the call to action from our keynote speaker is that we have to come together to craft a strategy to meet the regulator so that it will be difficult for them to say no to us. What role do trustees have to play in that? What role do fund managers have to play in that? What are the key issues we should take? How should we tweak it? So it's like a strategy session for the industry. Am I making sense so far? Wonderful. So keynote speaker, I'll start with you. There was a question from Data Bank for you. And I think I also asked a question about diamonds in strengthening your currency and also the issue around whether going offshore direct or investing in FX as a starting point. So please give him a mic to answer those questions, and I go to the others.
Thank you. I think for the question relating to whether it's a function of an underdeveloped bond market, the pension funds don't have to invest in government bonds. It's not compulsory. So there are government bonds that are issued, and the last auction, for instance, was about a month ago, but it's not everybody that subscribed to it. It was only 30% subscribed. So I don't think it's a function of that, the fact that the market is the bond market is underdeveloped. It's just in recognition of the fact that it is one of those asset classes that typically you would have in any dynamic market where you have corporate investors such as retirement funds and life companies. I hope I've answered your question. And the issue relating to which approach should be taken, whether it should be FX first, you know what, if this thing has to be done properly, convincingly so, it's going to require a full concerted exercise with asset liability models, not just at individual fund level, but at national pension fund asset level. In order for you to be able to go to the regulator and say, we've looked at this level and at this level, this is what makes sense. I don't think anybody here would be able to give you an answer to which one you should start with. It needs to be done properly, because the last thing that you want is to take shortcuts, and then the regulator says, okay, now you see what we told you, now it's 100% in government bonds.
You understand? So it needs to be done properly, not guesswork, with actual numbers being used. And then you also, because you have a better understanding of the market dynamics, you would know how much the industry can absorb, you understand, or can afford to take out. So this is not as easy as start with bank accounts, forex accounts.
No simple answers.
A proper exercise would have to be done.
Quickly on diamonds.
Diamonds, we are like traders. So our diamond mining model is that the government owns 51% of a company called Botswana. Botswana is a joint venture between De Beers and the Botswana government. The government of Botswana owns 51%, De Beers owns 49%. So when there's a new mining venture, the government will call on De Beers and say, we found these deposits. Okay, first of all, you go and look for the deposits, De Beers. Okay? And I've always asked the question, at what point do they tell them, no, we found enough, we think there's enough. But anyway, De Beers must go and do the exploration. Once they've done the exploration, they sign the papers, we own the mine jointly, we get 51% of revenue, you get 49%. They bring in all the infrastructure and everything to set up those mines. And basically all that the government does is receive a dividend from Botswana every year. That's what they use for recurring expenditure.
Wow.
It's a very good model. Now we've also got private mines, privately owned diamond mines, where the government doesn't necessarily have an equity stake in those mines, but it has or it receives a royalty from those companies, which is more or less similar to what the equity would give you at the Botswana level.
Wow.
So it's roughly about that 50%. So it's a model that works quite well because it allows private companies to come and set up these mines. I mean, over the last 5 years, there's one company called Lucara. They've unearthed the 4 largest stone diamonds ever found in the world. One stone was bigger than the size of my fist. It was sold for, I think it was $55 million.
Wow.
One stone.
Wow.
And that's a company that came in, bought some desert and started exploring, found diamonds, and now they're mining and making big money.
Wow.
Our government doesn't need to get involved. They just know how much was sold and
they take what is theirs.
Yeah, they want what's theirs.
Do you have political parties in your country?
Yeah, actually, we have political parties. We have, since independence in 1966, there was a political party, the founding political party called the Botswana Democratic Party. They were in power for 58 years.
Oh my God.
And then last year, they lost.
58 years in opposition. Now they've won. So the people who won just were 58 years in opposition. Yeah, because the guys who in power.
It's actually, what do you call it? An association of opposition parties.
Wow.
They got together. It's like a coalition.
Wow.
They got together, and people were upset with the ruling party. So
after 58 years,
yeah,
they got upset. You are very patient.
Sorry?
You are very patient in Botswana.
Of course.
You tolerated one party for 58 years.
Yes.
Wow.
Yes.
Now I have to come to Botswana. Let's put our hands together for him. We'll pause here. Let me take some comments from the other panels. We'll come back to you. So I'll start with the fund manager. So Ajay Boateng, I'm starting with you because you've said this a few times. So what are your thoughts, what you've heard from him, and also generally since we started?
Okay. Yeah, so for me, it's not a surprise. As I was hearing Paul talk, it's actually proximity, right? Everything that he said is available online. Like, we can all go out there and look at it. And in the last this is my 3rd year appearance, and I've been every day saying we have to diversify into global equities, right? the call is being streamed on YouTube, elsewhere. It's owned by Google, Microsoft. All of our companies send money to them every single month or every year. We don't wake up a day without all of us using the likes of WhatsApp to do our day-to-day activities. These companies are making money. It's about time we stop being sort of users of these products to actually owning some of them, right? And, for me, it's like, and the thing is, if you travel to UK, Europe, US, the moment you arrive there, your pension is a lot more similar to the Botswanan one. In fact, Botswanan pension is actually a bit more forward-thinking than them because they have a little bit more lower equity of around 50%, right? And so I'm not surprised that they've experienced the growth that they have. Now, in here, it's like, you can say it again and again and again, but it's finally really reassuring to hear it from an external sort of person, because that's where the results come from, right? Talking about it, like I almost sound like a broken record, but
do you think the government's, and this is plural government, reluctance to increase that foreign threshold could be because of our historical currency volatility, and they fear that opening the floodgates could actually worsen that? Because you do know that the exchange rate is possibly the lead indicator of economic performance. And because some of the countries that have done well have either pegged or have a relationship with, for example, Botswana, it's not just, Pula is not on its own. It has a relationship with the Morocco as well, right? So could it be that because of the flexible exchange rates we run and the problems there's a reluctance because they don't know the effect it would have on the currency stability?
Bernard, that's a very good question. I think it's a combination of things, one of which maybe some of it is attributed to that. But the other bit is actually familiarity and being proximate to it, right? So I think even though the current regulators allow 5%, no fund managers had actually ventured into actually doing it, right? Part of it comes with familiarity, just being around these investments and seeing how they perform in your portfolio over time. And then there's the other layer, which is FX being a very, very sensitive sort of conversation. And I think that had sort of stopped the industry from actually being emboldened and empowered to actually go for it, right? But I think it's a combination of things, but not one specific thing.
Is it true? He says even though the regulator allows 5%, no fund manager actually ventured into it. Is that true? Sorry, they stopped you?
Yes. So there was an embedded thing in there that before you actually go ahead and do it, the minister through the government through the Ministry of Finance needed to approve it first. So
that's the problem.
That is the problem.
Would you have done it? You got fined for doing it. Yeah. Oh. So that's the problem.
Yes. So even though the condition had been made in the guidelines, the conditions or the steps in which you needed to take to execute it were so strenuous that you were just better off not doing it.
Let me stay with fund managers. Robert Benin, general thoughts on what you've heard so far, and if you want to comment on this issue of why the reluctance to allow us to venture into foreign markets. Robert.
Yeah, thank you very much. And our guest speaker, thank you. It's unfortunate that the prophets like Ajay and Nana and others are not honored in their own cities and in their own towns. What our friend is saying, it's not rocket science. He said it so many times before. We all know, professionals in the room, we know that at the core of investment performance is asset allocation. If you're doing this for the long term, then you really need to orientate your portfolio towards assets that will secure that long term. There is no other way. I think what has happened is that we celebrated a win with the introduction of the second and third tier, and we're still basking in that win. We need to go back to the drawing board the same way with the agitation, with the effort, and then culminating into a committee, getting a paper out, going to the presidency, going to parliament, and then now we have this. Haven't done this for about 12 years. We need to go through that same process. break some of the mental blocks, and eventually do what we all know must be done. It's unfortunate, but all the professionals in this room know what must be done.
Yeah, just a follow-up there. You said we celebrated the tier 2, 3 thing too long. I noticed Botswana doesn't have a SNIT, as in they don't have a compulsory tier 1. Maybe that was their fortune. I don't know if that's making sense.
That's correct. We don't have, so all retirement funds in the country fall under one act, the Retirement Funds Act. Even the Retirement Fund for Public Service falls under and operates under the same rules and regulations as the Stanbic Bank Pension Fund, ABSA Pension Fund. So we've only got one set of laws for occupational pension schemes. Members that join the scheme, there's no other...
So we suggest that from ab initio, you were market facing, you were more realistic, because for us, we had SNIT dominators for how many decades before even the law to allow Axis or Petra to even exist. And the government got so comfortable with SNIT, who have a scandal every 5 years. So maybe, and because Robert, you always talk about strategy and the fact that we have to be locally. So I think we need to embrace our history and work from there to say, what does this mean for us? Because there's a certain hesitance on government, because SNIT has given us so many problems in the past that they don't want to create other SNITs, even though you guys operate with different rules.
So give me 2 minutes on this. I believe we need a dual objective here. I mean, the investment professionals in this room will tell you, anytime, and I use that all the time, anytime you want to build a portfolio, you want to have a good life, you want to, whatever you need to first start with your objective. What's the investment objective here? What's the target? What's the goal? And then we need to think about our risk tolerance level. What are we willing to tolerate if this doesn't work? What are the constraints? And I believe we need to go through that same process. So there are two main objectives we need to aim for as we start talking about what the next phase of the pension reform should look like. Number one, of course, the allocation to equities and international markets. But number two, we need to use the pension fund to change the structure of corporate organization in Ghana. Because eventually, we need these assets here. Even if we expose 50% of the portfolio to international markets, now we're about 40 billion. Next 10 years, probably at about 100 billion. So we need to find assets locally. The challenge we have is, as a country, and probably across the continent, we do not have strong finance functions. There's a lot of underinvestment in the finance function. This shows up in the way companies are organized and their financials are run. So banks are able to do business with the companies because you have your account with them, they see the cash flows, and they can give you a loan. And they are not relying on your financial statements. Because we're Ghanaians, and they know that if they ask you for a financial statement, you can go around the corner and get an auditor to prepare one for you. But if you want to invest, all of us, like Nana said, then you need an equity orientation. So now you need to start looking at, first, what are the financials? And Bernard, I've told you this story before. You can have a great business. You can have investors come to town. When they leave, they will just ask you, where are the financial statements? Because all the professionals in this room, they don't need to see your business. When they see your financial statement, they understand what is going on, and they understand whether this is bankable or not. Most businesses in Ghana don't have that. And that's the challenge. But once you do that, we'll have a ripple effect across enterprises in the country. And so we need to use our pension funds to encourage businesses. So we need a dual objective. We need a location of the pension fund supporting local businesses. Of course, we have to have some risk tolerance for the things that will happen, and we learn through it. We can only learn when we're failing. Learning is failing on our way to mastery. So that's the way we can do this.
So for you, the starting point is investing in local businesses.
Dual objective.
All right.
we're still using the pension funds, giving a significant allocation, and actually recognizing that the challenge is that they don't have the proper books of accounts.
Yeah.
No matter how big the size is, trust me, no matter how big the billboards you see of the company, you go in there as an equity investor, you don't have the basis for a decision. Banks can finance it because it's just a loan and they see the cash. Yeah. And if you are not paying, they can actually take the assets they take as collaterals. We are not looking for collaterals. We're investing in the business. So the governance has to be right. The papers has to be right. And that's how we do it. Once we do that, we solve a problem for the country and for the future of the citizens. Because if we don't have a great future, what are we then saving for?
Very, very important. So bear with me and understand my logic. So I'm going to William Mensah because William wears two hats. You're both a trustee and a fund manager. And you've been in this industry for at least 25, 30 years. So none of this is new. I mean, when I started doing radio at the professional level, 2004, you're already in this industry. So that's 21 years ago. So your first thoughts, before I even ask you any question, what are your thoughts?
Okay, not to belabor the point, but I mean, everybody knows where real wealth has been created.
Yeah.
Real wealth has been created in technology and all that. And we have not been able to play in that space. So we've lost out. That has been made clear. Now, besides the argument of currency, another excuse that has been given is that we should let our pension funds develop our local economy.
Yes.
Let our pension funds touch the real sector of the economy and develop Ghana. That's a good argument, but the question is, what is being done to ensure that when the pension funds go to the real economy, they will be able to develop the real economy and create that value? Efriye talked about real estate and talked about issues of land tenure, but it's even beyond that. If you go to the university campuses, they have the land. There's no problem of land tenure there. They have rights to the land, so you don't have an issue with land tenure. Now, I know a group that tried to invest in hostels on university campuses. Now, the problem they faced is that you know the income you can generate from the hostel. Incomes are predictable. How much rent will you charge? So they work backwards and say, if we want to make a return of 20% on the city, what should our cost of delivering a unit be to be able to generate that return? There's no one who could deliver a unit of hostels at that cost that will let them get that 20% return. Why? Because the hurdle rate, that 20%, is too high. Why is the hurdle rate too high? Because of the turbulent macroeconomic situation in which we are. So if we want, as a trustee, I really don't mind whether the money is going offshore or the money is staying domestically, as long as it gives a return that inures to the benefits of the contributors of the scheme. But are the fundamentals of our economy right for the money to even stay local? So if we haven't done that, and we have opportunity to benefit from the growth that is offshore, and every dollar that goes offshore will come back as multiple dollars, it's hard to understand why any regulator will have a problem with that.
So, I want to talk a bit about the macro situation, because we are clear what we need to do. We just don't know how to do it. Afriye said, almost everything Afriye said, he said, with the reset, we have a new president who's not that new, so he's experienced. He started well. He has 130 days. His finance minister also seems to be listening. What pitch can this industry make to this government that will make sense to them? That, look, the growth of the pensions industry is actually going to help make your macro more stable. Because it has to be win-win, right? Yeah. So I think, and it's not just for you, what is the pitch to Minister of Finance, BOG, and President? Even forget about MPRA, right? Because those are the big ticket guys.
So I disagree that we don't know what to do.
All right.
The real problem is that doing the right thing goes against the selfish interest of some people. That is the truth of the matter. It is not the case that we don't know what to do. The question, we are all happy with the stability we are seeing, but not many people are confident that it's going to be sustained. Why is it so? Because we've seen it before. We've seen it before. We've seen stability, inflation at single digits for 3 years, interest rates at 9%, 10%, and we are all happy. And then the next thing we see, there's an election coming up, and then every principle is thrown out because someone's interest has to be served, and then everything goes haywire. So I don't think the problem is what pitch we can give. The problem is dealing with the hearts of the people who are managing the economy.
No. My question is about us as an industry.
Yeah.
We all know what the government should do. So that's not what I'm asking you.
Okay.
Politics is not a contest of principles. It's a battle of interests. The government has its interest, politicians have their interest. As an industry, you have our interest. So my question is, the challenge for us is to say, how do you present these proposals in a way that a reasonable government can say, this makes sense for us to back down, because it also helps us achieve some of our short to medium term objectives. That's the question.
Okay, so I think that the main speaker answered, you can show them the numbers, right? It's easy to show them the numbers. We can even go back, right, and say this is how we've been running our pensions since 2012. Let's assume that we run the pensions differently, and we allowed, let's say, even 20% to go offshore. And that 20%, it all went into only funds. And model it back, and then show them that if that 20% that went out, even half of that value has come back into the economy, what would the impact be on the economy? So it's easy to model that. The data is there. So we can do some retrogression, go back from 2012, and let's assume that we modeled our portfolio allocation differently and what the impact will be. I think that will be something that...
Yeah. Just a general observation, I noticed that this industry needs long term, because we are talking about people's retirements. Just this morning, we read in the newspapers that even with the T-bills, almost 80% of the subscription was for 91 days. So T-bill is already short, and people are going for the short end, right? 180 something day was about 12%. So basically, we also need to talk about the investment appetite for long term, and that's all on the basis of the macroeconomy. So you're right, until there is a certain confidence in the long term, all of this is not going to happen. That doesn't prevent us from still making a pitch. So I'm going to continue with the flow. Let me come to Stanbic. Now, I like Stanbic because, you know, your parent is in South Africa. So you are cousins to him. But you are here in Ghana. So you've seen the best of both. And you are one of the better banks in the country as well. So any thoughts around how to reform the pensions industry in a gradual but progressive way? Robert. I'll call you Robert 2. So there's Robert 1, Robert 2. All right.
Thanks, Bernard. I think one of the things we have is that it's already in the investment guidelines. We have 5%. So the good thing is that we have to take opportunity of that. First, but there are some barriers to that. One is the minister that we talked about, Minister of Finance that we talked about. Then there is also the FX regulation from Bank of Ghana. Let's work within first the 5%. Okay. The first barrier is to go and speak to the Minister of Finance and ensure that within the 5%, we draw up the plan, the proposal. We go back to 2012. We look at the returns and how, if one has invested in FX,
what would have happened?
What would have happened? We
should show them the missed opportunity.
We should show them the picture.
Yeah.
Once we show them the picture, and then explain to them, get them involved, get them on board, sit down, discuss, and they buy into that. Going forward, within the 5 years, we can also show the picture to them what has happened. Then we can later on propose to increase the percentage rate to say 10, 20%. That's not the end. We have to speak to Bank of Ghana.
Yeah.
One of the things we do well with Stanbic is that sometimes we book a meeting with the regulators.
Good.
First, you may go in, they may not listen. But second time, when they listen to you carefully and the thoughts and the proposal that you put in across, they then buy into it and then work with you.
Yeah. Talking of missed opportunities, I want to just ask a question, not to slight any of you. I was at the National Economic Forum on the 3rd and 4th of March. This is the biggest platform the new government created to reset the economy. I'd like to know how many pension companies were there. If you were there representing officially the industry, can I see your hand? I think therein lies the problem. I think you're the only guy who was there. I was there, I'm a journalist, so I was doing what I do. But I thought maybe the pensions sector behind the scenes ought to have made a pitch. Because you're going to have 2 days of deliberation on the economy. How come pensions did not feature? Yeah, but that's the point. Why do you wait for the last hour? I'm not lighting, but my point is that NDC said they would do economic forum. All kinds of people were there who don't even have half the knowledge you have.
Yes, I think
So
there was a bit of a challenge in terms of how that invitation was also sent out. So not everybody could have just registered and gone. So
no, but guys, I need to say, look, the industry needs to also get more serious.
Yes, that's
because
true.
you can't tell me that a 2-day National Economic Forum, if you can't get an attendance there and you can't get your MPRA guy to listen to you, then you are not doing something right as an industry. Because if he can get to meet the BOG as one bank, clearly there's a certain challenge of working together. Now, if you don't admit that, how are you telling me that this discussion for 2 days live on TV for free? Even me, a journalist, was there for 2 full days. And only one of you was able to enter. Guys, that's not good enough. Seriously.
Yes, I mean that.
So admit that first.
That might have been like a missed opportunity for sure.
Yes.
Even me to get the ticket, I had to go and shake a few hands.
Oh Lord. No.
I had to, but I was determined to sort of make it there.
Yeah.
But I mean, we would take that feedback seriously as an industry, and I think going forward, it's something that.
So maybe some of the discussion should be around how the industry needs to work effectively. Because don't forget, he said we need to put away our selfish parochial interests and work as a body. Nobody's going to take you serious if you can't present a cogent, unified front. And by the way, pensions are very sensitive. When the debt exchange happened, the pension bondholders picketed at the Ministry of Finance. A former Chief Justice was sat there, and they slept there for the minister to back down on his decision. These are pension bondholders led by Edouard and Entry. Right? And you are the guys who they are like corporate lead. We didn't hear you in the conversation. So there has to be some risk taking. There has to be some leadership. Otherwise, we're going to talk next year. Nothing's going to change. All right, honestly. Okay, so let me move on quickly. Robert, finish your point. Robert 2, or you're done.
So basically, that's what we have to do. And then again, on the local side, I believe we have so many opportunities. And one of the things that Friye mentioned was how to invest in the equity market. Big returns coming in there. That will also grow up our local industry and even create employment, which is a big issue for us. But one of the things which we have to work, even with the fund managers, with others as we work along, is corporate governance. You mentioned about companies and small units not having good accounts and other things. The bigger one, the blue chips ones, have good corporate governance, the board working, other things working. So those can be also introduced, the small unit ones, and that will boost the economy. Once the economy is boosted, it helps everyone in the economy.
Wonderful. Cocoa Board is my next target. Yvonne, you are the Deputy Director of Finance. You are a trustee. General reflections on what you've heard so far, and any recommendations on how we can get better as an industry.
Okay, thank you very much. I think I'll start from the main speaker. His thoughts on our industry. Basically, they are doing offshore, but we are doing the reverse. But I think even the reverse that we are doing, have we taken the opportunity that has been given to us, as Robert said, the 5%? Have we been able to utilize it? Yes, there are challenges in implementing it, but what have we done about the challenges that came on our way? Have we been able to come together as pension scheme custodians, administrators, to address this on our level? So for me, we have to work on ourselves. As you said, the pension industry itself has to work on ourselves. We have to work hard, get the minister, the Bank of Ghana, to agree to us to do the 5% that has been given to us first, then we will know what we can do next. Also, talking about land tenure and other things, yes, there's a challenge. There's a challenge everywhere, and somebody was talking about the universities. We even have challenges with that, because we have a land in the university and they have sold parts. So it's everywhere. So if we really want to do this, then we must reassess ourselves, that is rethinking the policies that we have to, innovation. We have to bring in new things that will move the industry forward, as we have all said this morning, and I believe that things will go forward.
Thank you. Let me come to GPHA, Nana Kwame. So, any thoughts on what you've heard so far, and what other recommendations can you make for us going forward?
All right, thank you very much. A lot has been said, but for me, what was really a major one for me was the last slide of the keynote speaker. Because I sit as a trustee, and it is the interest of our members that we are protecting. And if they're going to retire into a better lifestyle, it depends on what we are able to do for them. I mean, it is this same problem that led to this 3-tier. And if at the end of the day we are going to have the managers of the economy play all the play, and we end up still not getting the quality of life for pensioners that we are looking for, then we would be fighting a losing battle. And so I saw that as the major thing for us. And it makes me think, so the regulators, the laws that have been put in place, are they really aimed at giving us that end object of a good pension? Or the bottlenecks in getting access to do even the 5%? Are they really looking at the interest of workers? So I think that one thing that we need to do, and politicians listen to this language, votes. And votes are coming from the pensioners.
Yeah.
And so if we can even use the organized labor route to give some substance to what the fund managers are going to present, show that we all together are looking at this end object. They need to look at that. We need to also look at the interests of our people, and then that would bring some good pressure to bear on on the managers of the economy. We have the Chamber of Trustees, corporate trustees. We have employer-sponsored schemes. There is no association that pulls them together, and so if corporate trustees go, they go alone. Then the employer-sponsored scheme trustees are sitting without any input. Their voice is not being heard in that space of advocacy. And so if we could also look at creating another chamber of that, or a bigger chamber that will pull all trustees, corporate, employer-sponsored together to give a stronger voice, it will also help in pushing the agenda and giving ear, or causing managers of the economy to give ear to the voice of reason that we are
I love this. So imagine if we had done this, the TUC Secretary General would obviously include 1 or 2 lines around this matter, because they see how it relates to the future of all pensioners in Ghana, and the president will be forced to make a commitment there, because in fact, in the first meeting with organized labor to discuss their minimum wage, he was there personally, and he committed that he will be in the next meeting himself with the minister. So imagine if between now and that meeting, people like Nana Boahen, we get together and let organized labor understand why this is better for their future, show them how much money they would have lost or they've gained. So I think the call to action is very clear. So thank you for that point. For want of time, I'm trying to sort of arrange the key things I've heard, and then we can cross the T's and dot the I's. So one of the broad things I've heard so far is that investment in local companies, equity positions must increase. But from Robert, some work needs to be done on the way companies are run, so we are more comfortable doing this. But clearly, we cannot survive by just ignoring local companies, because it also makes sense. I mean, why should a Norwegian pension fund invest in a tech company in Ghana and our pension funds have no business with that? So it's clear we have to do something around that. What I don't know is who will bail the cat and what work must be done for that to happen. But Robert, thank you for that point. Number 2, a lot of you have said that even the 5% that we have, when we try to use it, it wasn't agreed. So it's very clear there has to be an engagement with government to at least allow some of the blue chip guys, those with credibility, to explore the 5. And when they see the benefit, the best way to convince them is not through slides, but basically the returns, which would have been occasion. So clearly, and then of course the issue of organized labor as a bargaining tool, or basically pushing the agenda of getting some reform in the pension sector. So those are the 3. Have I missed anything so far? By the way, is there an association of pension trustees or pension fund managers or something? What is it? What is it called? Chamber of Corporate Trustees. And how many members are in there? Oh, 23. Okay. Overseeing what volume of, what's your AUM collectively? The entire pension industry. Wow. Isn't that a good starting point, Paul? Give him a mic.
If this thing is going to, okay, first of all, let's agree as trustees that all of what we've been talking about actually makes sense. Do you agree?
Yeah.
If we agree, the next guys that you need to speak to, this chamber, the next people that they need to speak to is organized labor. Those guys can be very loud.
Yeah.
If they have been convinced successfully.
Yes.
And if they know that doing that is in the interest of their members, you can demonstrate it to them and say, this is where we were in 2012. If we had done this, this is where we would be. Mr. Union member, do you see how your member has been prejudiced? How do we sort this out? They'll make the noise for you.
Yeah, yeah.
But yeah, I mean, when you go hunting, you don't take one bullet.
Of course not.
You take all the bullets that are around you, because you might miss. So you need more voices to articulate the same thing. It might take time, but eventually somebody will see that this actually makes sense. Unfortunately, if I don't know, how often do government change here?
4 years.
Every 4 years. So,
actually, every 8 years.
Okay, every 8 years. so sometimes the problems that we have with Botswana is that you advance something to a particular ministry. By the time that they get to understand it, he's now out. It's another minister.
Same
but
story.
Yeah, but honestly speaking, you need as much support from the labor organizations, all the institutions and service providers that are involved in the industry, all the trustees. I cannot believe that if all of those people and bodies are saying the same thing, nobody is going to listen.
Definitely.
Somebody is going to listen.
Wonderful. Put your hands together for him. So this is what I want to do. I want to invite Efriye back to give us a way forward, right? Because you sort of set us off with these 6 pillars. And so you need to tell us what next. Then we'll do the vote of thanks. Lunch is served, and we can eat here. So don't be in a rush. So let's welcome our convener, Efriye, again. Put your hands together for Efriye. Thank you.
Thank you very much, panelists, and thank you, stakeholders, for making it to this event. So we started these conferences in 2019 because we thought at Access that the industry was missing a point. Between 2012 and 2017, we saw the behavior of non-deposit taking financial institutions. And yet pension funds were packing money into some of these MBFIs without regard for the risk they were going to carry. And so along the way, we nudged the MPRA, and the MPRA intervened. After the financial sector cleanup, government absorbed the debt, in quote, the toxic assets. And yet we all thought government was clean. And so in 2019, we thought that maybe we were getting something wrong, because we saw there was going to be an implosion at a point. And so we should organize a conference to kind of share ideas and to form a unified consensus. And since then, every year after the conference, we share a policy proposal with the MPRA, and we also give a copy to the Ministry of Finance. By far, I think this has been the most enriching, and we are going to continue that culture. The feedback I'm getting from this is that we need to deepen our engagement a lot more. We need to get labor unions on board, and so it will be important for us to do what Paul has suggested. We'll do back testing under various scenarios and express what the pension outcomes today would have been if we were diversified, maybe 20% offshore, 30% to 50%. And we'll share that insight with labor. So it's one of the things, Bernard, we hope to do. Nana has also given us a call to action for us to foster the creation of a bigger chamber. I serve on the Governing Council of the Chamber of Corporate Trustees. We've been trying to make overtures towards the employer-sponsored schemes. I think we've received the call to deepen engagement to ensure that that happens. And then the last one, if we have to start, we can start from the 5%, which is cast in law. And we are going to work together with the Chamber of Corporate Trustees to begin the advocacy in earnest. And so the discussion here is not going to be the normal Ghanaian talk shop. That is not our culture at Access. We are a company of action, and we work together with our stakeholders, the fund managers, the custodians, and our trustees to ensure that we advance the future of this industry. So thank you very much, Bernard.
Thank you, Efriye. So let me bring up quickly General Manager for Access, Park Kofi Ankoma, to do closing remarks, which will be stroke vote of thanks. And then Isaac Oparinoi will give us a closing prayer as well. So Park Kofi, vote of thanks, and then Isaac, item 13.
Okay, thank you very much. But I actually thought if we did justice to the closing remarks. He summarized everything that we came here to discuss. But then let me just add a few more words to what Efriye just said. We came here with the theme of building a resilient portfolio. We've had a lot of presentations. Efriye came in, talked about how we can internalize our investment strategy. Paul also came in to tell us how we can externalize our investment strategy. But really, I think we can all agree that whether we do it internally or externally, government securities is not the way to build a resilient portfolio. It is very important that we take that back wherever we are as decision makers, as trustees. We are currently at the crossroads. Remember, if we also shared phase 1, 2012 to 2017, it was a conservative period. 2018 to 2020, we were looking at the risk aversion period, and then we moved into the siege period. I think I would, with his permission, add a phase 4. We are at the crossroads. I think phase 4 is the renaissance. We need to gather all the discussions, all the inputs that have come in here, compile it with actual data, and engage the right authorities. I'm happy to see a number of our friends from the labor unions. If you are here, please show me, kindly wave to me. I see the unions guys here, Cocoa Board, GPHA, and Co. Thank you so much for making time to be present. And I think this is a start to what we want to achieve. It's unfortunate we didn't get the MPRA coming here. It would have been the whole shebang of the industry so that we could easily advance it going forward. But as I wrap up, I want to take 2 words from Efrie and Paul. You can only create value for your members if you have a diversified portfolio. Paul said that, and it's a very big takeaway for me. Let's not think Government of Ghana is giving us 25%, so we'll put everything in Government of Ghana, when a diversified portfolio will probably give you 17% over that short term. What we are ending up doing is we are creating CD billionaires whose CDs or billions would only buy bread at retirement. We need to create value for our scheme members. So a diversified portfolio is the way to go. And as trustees, our collective inaction, and let me add action, can jeopardize the future of millions of Ghanaians. We hold the future of Ghanaians, those we work with, those we work for, in our hands as decision makers. Let's make sure we take the right decisions in their interest, not for our interest, so that at the end, we all go home smiling. On that note, I say thank you all for making time to be here. It's been a 4-hour engagement, and we do appreciate your time and efforts. Thank you very much.
Thank you very much, Paul. Actually, not Paul. So we now bring Isaac Oparinoi, and he'll give us a closing prayer. And for any other thing, yes.
Respectfully, I would like to ask us all to stand up as we take the closing prayer. And as you stand up, if you don't know the person sitting to your right or left, please make sure you do that after the closing prayer so that you make a friend after here. Shall we pray? Our dear Lord, we are so grateful for today. We thank you for our meeting here and the discussions that we have had. We thank you for the wisdom that we have shared and the lessons we have learned. And we ask for grace and strength from you, O God, that empower us and enable us to be able to implement the good things we have heard from here. Help us to even develop better ideas to the contribution and the growth of every scheme or every fund that we are part of. As we depart, we pray for traveling mercies. We pray for your mercies in every aspect of our lives. May we be blessed because of our gathering today, and may it be said that because of our gathering here today and because of your faithfulness, our lives have been better. We thank you for your faithfulness. In Jesus' name, amen.
Thank you very much. We'll see you next time. Bye-bye.